Good morning. I'm going to call the Consensus Revenue Estimating Conference for January of 2026 to order. I'm Kathryn Summers. I'm the Director of the Senate Fiscal Agency. Along with me, from far to near, Jen Flood, State Budget Director, Rachel Eubanks, State Treasurer, Ann Cleary, Director of the House Fiscal Agency. We are here per MCL 18.1367B that requires a revenue estimating conference in January and also in May. The conference is required to make forecasts for the fiscal year in which the conference is being held, so this year, as well as the next two fiscal years, and a revenue trend line for the 2 years after that. Anyone have any opening comments before we kick things off further? Okay. Thank you all for being here. So with that,
you can tell them all the.
Oh, thank you, yes. All of the documents and presentations are on both fiscal agency websites, so House Fiscal's website, the Senate Fiscal's website, as well as the State of Michigan website, michigan.gov/CREC. So we don't have printed copies anymore, but you can find all of those documents and presentations on any of those websites. Thank you. We will start this morning with a U.S. and Michigan economic outlook and state revenue estimates. And we would like to call up Gabe Ehrlich and Daniil Manaenkov from RSQE at U of M. And I will, while they're coming up, I will read bios. Dr. Gabriel Ehrlich is an economic forecaster at U of M, where he is the director of RSQE. His work has been discussed in The Economist, The Financial Times, Washington Post, and he's published articles in the New England Journal of Medicine, Review of Economics and Statistics, and a whole lot of other things. I'm not going to keep going, but I have them if anyone's interested. Daniil, Dr. Daniil Manaenkov is an economic forecaster at U of M as well, lead research area specialist at RSQE. Main areas of expertise are macroeconomics, monetary economics, and applied econometrics. And again, much longer bios. Happy to provide those for everyone. Anyway, welcome, and we always look forward to hearing your presentation. Take it away.
All right, thank you for the introduction. Can you hear me all right? I'm not going to steal a joke from our predecessor, so let me jump into the talk. So thank you for the introductions. It's always a pleasure and an honor to be here, no matter the weather outside. This work that we're presenting is basically co-authored by the whole RSQE team, and some of which are in the audience. Like usual, I'll talk about our national outlook, starting with the current state of the economy, and then Gabe, or Dr. Ehrlich, will talk about Michigan outlook, and we'll take questions jointly afterwards. So the outlook I'm presenting you today is an update to what we prepared for our November Outlook conference, which we basically adjusted to take into account the data that has come out since. So I'll start with how things look for the broader economy. And first, the economic data release schedule is still quite delayed. So we got the third quarter national income product accounts data just before Christmas, about 8 weeks too late. So here I'm showing you the results of that data, and I'm plotting in the solid black line is the quarterly pace of, annualized pace of real GDP growth. And the latest reading was at 4.3%, which is pretty good overall. So the colored stacked bars are showing contributions of key aggregates to that headline number. And you can see that there's a lot of movement, particularly blue and green bars. So for that reason, we prefer to look not at the headline number, but at the sum of the maize and blue bars, which represent contributions of personal consumption expenditures and business fixed investment to the economy. And we think it's a better measure of what's going on with trend of growth. So that measure, the sum of the blue and maize bars, sum to about 2.6 percentage points out of the 4.3 that I told you the headline is. And it's just a hair up on that reading in the second quarter, and basically comparable to where this reading was for 3 quarters of 2024. So it's pretty solid growth. The rest of the difference between the consumption and business fixed investment and the headline growth was this time was the blue bar. But in general, the blue bar and the green bar are very volatile, and those represent net exports and inventory investment. Those jumped around this year, largely responding to tariffs, threats of tariffs, and news of tariffs. And a little bit of preview, we have a little bit of data for the fourth quarter. That's probably going to be another very large bar that attributed to net exports. So with this, let me jump into talking about the labor market. So we currently think that the unemployment rate is the best metric to be looking at. Normally, we prefer to look at payroll job gains, but lately those have been definitely affected by what's happening to net immigration. So the unemployment rates are basically our best bet at looking at and understanding what's happening in the labor market. So here I'm showing you two metrics. The headline unemployment rate is in blue and at the bottom, and the broader so-called U6 metric is in yellow and is up top. First thing to notice, there is now a missing data point in October because the survey was not run. So in the December reading of the headline number was at 4.4%, and it was down from 4.5% in November, which itself was a little bit elevated due to the aftermath of the government shutdown. But the latest reading is flat with September, but if you look at it, it still appears to be trending up slowly. The broader metric, the U6, also declined in December compared to November, but it is up relative to September. And again, you can still see it's probably trending up. So in general, the trend is slow deterioration, not to the point where we're worried, but the direction is a concern for the Fed. Now let's look at jobs. Here I'm showing you two charts, which are essentially the same thing. I'll talk about the maize line a little bit later. But the blue line is the headline month-to-month payroll job gains as reported right now. The two most recent readings were at about 50,000 jobs per month. In October, we got the deferred resignations from the federal government finally showing up in statistics. So the federal payroll lost about 180,000 jobs that month, pulling the aggregate below zero. But that's one-time occurrence. Now, the yellow line is what we think the blue line is going to look like a month from now. So the blue line, at least for the past year, is typically a survey-based estimate of the complete job count in the economy. But the Bureau of Labor Statistics does get a complete count just with a delay. So, and they re-benchmark the blue line to be closer to what the complete count says. The complete count, we don't know exactly, but we have a preliminary estimate that as of March 2025, it's going to be about 900,000 jobs lower than currently reported. So the yellow line basically spreads that 900,000 over the previous, like between two surveys. So between April of 2024 and March 2025. So looking overall, it looks like pretty weak employment growth has been going on for a couple of years, and we expect it to stay there at least in the near term. Now let's talk about a little bit more of the job market rate metrics. So here I'm showing you what's happening to labor demand. And the encouraging development of recent months, I would say, is that the job openings rate, which had been sliding for quite some time, appears to have stabilized both in the government data, which is shown here in blue, and in the private sector data, which comes from Indeed.com, a job aggregator site, and it also appears to have stabilized in recent months. So it basically tells us that maybe the labor market deterioration could be stabilizing. So now let's talk about inflation. So here I'm showing you headline CPI in maize, core shelter CPI in blue, and core CPI in green. Again, you can see that we now have a missing data point in October because the survey was not run. Additionally, the November CPI survey was started late, which possibly introduced extra noise into the November reading. And we got the December reading just earlier this week. In general, the trend is okay, but the missing October survey introduced some extra technical peculiarities, which basically lowered the readings for all of the three readings just by a little bit. So they are currently understated by about 1 month's worth of shelter inflation, and that understatement will go away in April 2026. So in general, these are, again, as I said, slightly understated, but we can still gauge a trend. The trend overall is it's still elevated inflation, but it's not moving in the wrong way, at least. So anecdotally, a lot of survey data suggests that some businesses were deferring tariff-related pass-through of prices until after the holiday season. So we think the Fed is going to wait at least for early 2026 data before they decide which way things are moving. And I'm going to mention this briefly again soon. So now let's talk about a few other metrics that I think are helpful in framing our forecast that we present to you today. So here I'm showing you the Institute of Supply Management's diffusion indices for the manufacturing and the services sector. First thing to note is readings above 50 indicate expansion in the sector. Second thing to note is the services sector is much, much larger. And it's more important for the overall growth of the economy. So manufacturing has been shrinking for some time. We're hoping it's going to turn around soon, but it's not there yet. The services sector index basically jumped in December, but it was at solidly expansionary levels in October and November as well. So for the quarter overall, I think the average is about 53, which is basically consistent with continued moderate growth in the economy. One big story of the recent growth has been the resilience of consumer. And here, I think the developments in interest rates should help preserve the momentum. So here I'm showing you three things. First, there's a government rate in green at the bottom. And here we see that the 5-year Treasury yield has come down some in recent months. The other two metrics are consumer-facing rates, the new vehicle loan rate and the mortgage rate in blue and maize, respectively. And both of them declined in recent months, which should help sustain at least some consumer spending. Additionally, not pictured here, but the delinquency rates for a lot of consumer loans appear to have stabilized, which should help drive down some of these rates further down and sustain consumption. Not everything is rosy, so the housing market is pretty stressed at the moment. So here I'm showing you two metrics. First, in blue, is the National Association of Home Builders Housing Market Index. And it is a diffusion index, so readings below 50 indicate contraction. So it's not been reading great numbers for more than a year. The other metric is the volume of loan applications for purchases by the Mortgage Banker Association. Here, the trend is more positive. This metric has been trending up since the beginning of this year, but from a very, very, very low level. So one silver lining here is that the blue line has a subcomponent for future sales about over the next 6 months or so, and that metric has turned expansionary since October. So we think that the residential construction market is probably still hurting, but we're hopeful that it will turn around sometime during 2026. Let me jump into our policy assumptions that underline our forecast, and I'll start with trade. So broadly speaking, the trade-related news have changed from broad country-level tariffs to more specific sectoral tariffs. So with this, we think that large jumps in overall tariff levels are less likely now. Now, further deals are possible. Some exemptions are plausible, especially focused on some consumer-sensitive goods. But on the other hand, there are some Section 232 investigations that are still ongoing, and we may result with sectoral tariffs coming online. So overall, though, the big development is the effective tariff rate that we see in the data so far is running far below of what people estimated maybe through summer, just based on statutory rates and old trade patterns, which basically means that businesses are re-optimizing their trade flows very quickly. We expect the average tariff rate to stay roughly in the same area, but it's conditional on other things, being as they are. And we know that the USMCA, the trade agreement with Canada and Mexico, is up for renewal this year. Whatever comes out of it, we are not expecting any large changes in the North American trade landscape. So that's our assumption in the forecast. Let's talk about monetary policy. So we're currently, the Fed funds rate is at 3.5 to 3.75, and we think it's still somewhat restrictive. So the labor market is somewhere between somewhat stable or maybe still slowing a little bit. The unemployment rate, so the inflation is still elevated, and as I said, there's risk of more tariff pass-through early this year. So it means that the Fed's dual mandates are basically in conflict, and they must decide the risks to which are more important. So in October and December, they decided the labor market risk was more important. Going forward, we think they're going to wait until they see the developments on inflation before proceeding with further cuts. We still think they're going to cut a couple of more times this year and bring down the Fed funds rate to a more to closer to what we think is a long-run neutral rate, which we think is about 3 to 3/4% range. And finally, the fiscal policy. There has been little action since the One Big Beautiful Bill Act passage this summer. There was a federal shutdown. It's going to mechanically subtract about 0.6 of a percentage point from fourth quarter GDP growth, and it's going to come back in the current quarter. We currently do not expect another shutdown. Now, Republicans in Congress have the power of reconciliation for at least another year. At least when we were doing this forecast, it was not clear if they're going to plan to use it at all. It's possible that there may be a push to boost the defense consumption to 1.5 trillion, or maybe do something with healthcare. We have not assumed that. Additionally, the possibility of a divided government after the 2026 elections is quite significant, which will limit further action. So our forecast is constrained to action that has been prescribed by OBBBA, which is hefty tax refunds starting this year, and Medicaid cuts starting in 27 and continuing in 28, as well as some effects of pretty generous investment incentives contained in the OBBBA. So with this, let me jump into our outlook. And again, I want to stress that this is an update to what we presented in November, where we reacted to the incoming data. So on this chart, I have the quarterly path of annualized GDP growth in a solid blue line. And as you can see, it jumps around a lot. So we also show the red line, which is the sum of contributions of consumption expenditures and business fixed investment, which is a better measure of a trend growth in the economy. So for the headline, we're expecting 2.6% growth in the fourth quarter, and the contribution of consumption and business fixed investment is going to fall to about 1.6 percentage points from about 2.6% in the third quarter. And the reason is that we expect consumption to grow slower, and part of the explanation why the consumption is going to grow slower is the slower pace of vehicle sales in the fourth quarter after the expiration of all the EV tax incentives, but also because of somewhat higher prices. So the difference between the contribution of consumption and business fixed investment in the overall GDP is more than explained by what we think is going to happen with net exports and inventories. We have penciled in about 1.5 percentage points there. I'm just going to mention that if you were to go to the Atlanta Fed estimate, the GDP now, as of yesterday, the overall growth estimate was 5.3%, and 3 percentage points of that was due to net exports. And that's because we got early data for October. So it's an early estimate. It will certainly be revised, but expect large movements in trade to continue, which is, again, why we plot the red line, because we think it's a better estimate what's going to happen in the economy. So after the first quarter of 26, where we get a rebound in the government contribution, the trend is going to be toward 2%, and the red line and the blue line is going to converge there. Now let's talk about the labor market projections. Again, so here I'm showing you historical data for fourth quarter, but we're missing October. So we are averaging November and December metrics where we have them. In general, as we said, we expect some stimulus from the fiscal policy and some stimulus from monetary policy going forward. So we think it's going to allow the unemployment rate to stabilize at a 4.5% level over the next year, and then ever so slightly drift down starting in the middle of 27. So the yellow line here shows our labor force participation rate. And here there is a gravity pool of ongoing retirements, but we also have much slower net immigration, and we have a pretty solid growth. So we think there's going to be a solid labor demand. This is going to be drawing people back into the labor force, or making sure that they stay in the labor force. And that, as a result of that, the participation rate is basically going to be flat and defy the pool, the downward pool from the retirements of the baby boomers. Here's our projection for job gains in the economy. We expect in the near term the private job gains to stay around 50,000 mark, 50,000 per month mark, and then slowly drift toward about 100,000 by the end of 2024, beginning of 2027. The difference between the blue line, which is the total job gains, and the yellow, which are private job gains, is government, and we don't expect government payroll increases over 2026, but they will return some in 27, in 2028. Here's our projection for inflation in the economy. We are expecting some additional pass-through, but it's going to be limited, and it's going to peak early in 2026, and it's going to start diminishing in the rest of the year. In the second quarter, the statistical artifact that I mentioned earlier is going to reverse itself, so we're going to have a little bit of a jump in inflation in April, and that's going to boost the second quarter. Year-over-year core inflation is going to rise a little bit early in 2026 and peak at about 3.4%, and then start declining, coming down to about 2.7% by the end of 2028. In the near term, the headline CPI, which is shown in yellow, is going to run behind core because food price inflation has been muted and energy prices are pretty low at the moment. But that effect is going to wear off by the end of this year. Interest rates are shown on this chart. The 3-month Treasury bill, which is shown in red, is going to follow the Fed funds path, and we expect 50 more basis point cuts. So that's basically what's going to happen to the red line. The blue line gives the 10-year government yield, and we expect it to stay roughly flat at 4% over the course of the forecast. The mortgage rate is shown in yellow, and it does decrease even relative to the 10-year government yield, because the spread, the excess spread that has developed over the recent years, is going to be shrinking back toward normal over the course of the forecast. And finally, for housing, we think it's going to be relatively stable in the near term. I have the singles here in blue, and I have the multifamily starts in green, and the total in maize. So we think that housing is going to be somewhat stable in the next few quarters, but when it starts finally improving later this year, it's not going to be going gangbusters. It's just going to be modest gains, and it's going to be trending up for the next couple of years. On the multifamily side, we think that the strong economy is going to sustain demand for rentals. So the green line comes down just a hair, but basically stays flat. Finally, I have a large list of risks here. We think that major quantifiable risks are fairly balanced, although there are still large tail risks on both sides of the mandate. I think I can talk forever about this, but it's perhaps best left for Q&A, except for that AI bullets. Please direct all the AI questions to our next speaker. With this, I'm going to turn it over to Gabe.
Great. Well, thanks, Daniil, and thanks again for inviting us to present today. It's always an honor to participate in the CREC. I'm excited to share our outlook for Michigan's economy over the next few years with you, and I'll start as usual by showing you where Michigan's economy is in the latest data. This graph shows two measures of employment here in Michigan. The blue line shows what we call payroll employment, or the number of jobs in Michigan, excluding self-employment. And the yellow line shows what we call resident or household employment, which is the count of employed Michigan residents, including the self-employed. Both lines show 12-month growth rates, so year over year for each month, and they end in November of 2025, which is the most recent state-level data. And, Daniil already pointed out, I don't know, there's a gap here in the yellow line for October of 2025 because the data wasn't collected during the federal government shutdown, and you'll see that in a few places in my presentation. Both of these measures were slowing down from early 2022, right, when we were still, I'm going to give up on the pointer here, but they were slowing down from early 2022 through the middle of 2024, which maybe I won't give up on the pointer. Right here, you can see that's July of 2024. But they've diverged substantially since then, and so it's definitely been a little bit puzzling for us. But we suspect the underlying momentum is somewhere in between these lines. I'm probably, honestly, a little closer to the yellow line. The simple average of these two measures would suggest that Michigan has been experiencing slow but positive job growth recently. Daniil already talked about the benchmark revision to the payroll job measure in blue, and that's coming up soon. We received a preliminary estimate of the revision for Michigan this fall that would essentially knock out the growth in the blue line through March of 2025. March here is, here we go. March is that point right there. So you can see March was relatively slow. So even extrapolating out, if you think, okay, we're going to revise that down close to zero, even if you were to extrapolate that forward beyond the data that beyond the data that the preliminary benchmark revision applied to, the payroll job growth, oh wow, that's fancy to know, would still suggest some positive payroll job growth recently. So, what we think is that the revisions are likely to bring these measures closer together, although a gap may still remain. And just one other point, we did look at the history of these preliminary benchmark revisions at the state level, and there is some precedent that they don't always translate through to the final revision. So, I don't want to sound overconfident about what's going to happen when we get the revised numbers. So moving to unemployment, even though the count of employed Michigan residents has been falling, Michigan's unemployment rate has actually been edging down recently as well. The state unemployment rate has come down from 5.5% last April to 5% in November, even though the U.S. rate was rising very slightly. The Metro Detroit rate has fallen to 4.7%. Although the Grand Rapids area rate moved up to 4.8% in November when we seasonally adjust the data. And you can't exactly see that. There's a yellow dot on this graph that's kind of behind the green and blue dots right at the end of the graph. And you might wonder how the unemployment rate can be declining at the same time that the number of employed state residents is falling. And the answer is that to count as officially unemployed, it's not enough just not to have a job. You have to be officially part of the labor force. So for instance, we don't want to count retirees as unemployed. They're choosing, right, not to work. And so, they don't fit into that traditional definition of unemployed. So to count officially as part of the labor force, if you're not working, you have to want a job and have actively looked for a job recently. So be actively looking. And that qualifies you as being officially part of the labor force, which is necessary to be counted as unemployed. Michigan's labor force participation rate has dipped from 62% last April to 61.3% in November. And the decline in the participation rate has kept a lid on Michigan's unemployment rate, even as employment has been falling. So the reasons for the decline in the unemployment rate aren't necessarily the reasons we'd prefer to see. This slide shows you the ratio of job openings to unemployed persons in Michigan in blue and the United States in maize, as measured by the Bureau of Labor Statistics Job Openings and Labor Turnover Survey, or the so-called JOLTS. And these measures provide a simple summary of how tight the labor market is, with a higher number suggesting a tighter market. A ratio of around 1 is often considered to be roughly balanced. This ratio fell to concerning levels in Michigan in 2024. So you can see, here in late 2024, we really were seeing labor demand cool off relative to the number of unemployed residents in Michigan. But it's rebounded in the data that we have so far for 2025. Nationally, the ratio has continued to decline. It fell from just about 1 in September to about 0.9 in November. And our most recent number for Michigan comes from September, and it registered about 0.9 as well. So labor demand is now a bit weaker than in the years leading up to COVID, just as a point of reference. And finally, I have to tell you that this might be the last time I'm able to share this graph with you. The Bureau of Labor Statistics is set to eliminate the monthly state-level JOLTS data after next month. And so this is one of my favorite graphs. I love sharing. I think there's so much economics encapsulated in this graph, but unfortunately, I think its time is coming. So with that, I'll turn to our forecast for the Michigan economy. And I'll just talk about some of our key policy assumptions as they pertain to Michigan. Starting with tariffs, the most significant development from our perspective recently was the extension of rebates on tariffs on imported auto parts of up to 3.75% of domestically produced vehicles MSRPs through 2030. Those extensions help maintain competitive domestic production costs in our calculations. We estimate that current tariff rates on imported vehicles average about 11.7%. And we expect them to push vehicle prices up about $3,100 after the supply chain and prices have adjusted, averaged both over imports and domestically produced vehicles. And I'll get to the effects on sales and production on the next slide, but I wanted to talk about a couple of other policy issues first. The One Big Beautiful Bill Act eliminated penalties for missing corporate average fuel economy standards over our forecast window. Obviously there are costs associated with that policy, but, without getting into those, we do project that it will boost the Detroit 3's share of the light vehicle market by about 1.8 percentage points relative to the trend, because the Detroit 3 produce a high share of low mileage vehicles. In the short run, though, the sudden pivot away from support for EVs is imposing some pain here in Michigan. For instance, General Motors recently announced about 1,200 layoffs at its Factory Zero plant in Detroit-Hamtramck. Additionally, the Big Beautiful Bill also imposed cuts to Medicaid funding and premium support for insurance purchased through the Affordable Care Act exchanges. And those cuts weigh on healthcare employment during our forecast. And finally, I haven't mentioned it here on the slide because Daniil already mentioned it, but we've assumed that there won't be major changes to the USMCA in our forecast, but that's obviously a wild card in the outlook. Okay, on this slide, I've taken a dive into the tariffs' effect on vehicle sales and production. The tariffs will raise the prices of imported vehicles, and all else equal, that will cause consumers to switch towards domestically produced vehicles, right? And that's why tariffs are sometimes called protectionism. All else equal, they will protect domestic manufacturing. We estimate the strength of that effect at almost 930,000 units per year after the supply chain has had time to adjust. But I said all else equal, and obviously not everything else is going to be equal. And this is, really the point I was making all throughout 2025. There are also opposing effects from the tariffs. First, the tariffs on parts increase the costs of domestic production. Second, they invite retaliation from our trade partners, or they may invite retaliation. And third, the tariffs reduce consumers' real purchasing power. We estimate that those effects will reduce total U.S. light vehicle sales by about 530,000 units per year and reduce exports by about 120,000 units per year. So adding up those effects, the protective effect and then those two offsetting effects, we estimate that the current configuration of tariffs will eventually boost U.S. light vehicle production by about 275,000 units per year, or about 2.7% relative to 2024 production. If Michigan were to maintain its share of domestic production, that would translate into a gain of about 4,800 jobs in the state auto sector relative to the trend. Earlier last year, this exact same analytical framework suggested that the tariffs would reduce domestic vehicle production because the negative effects, the two downward bars, outweighed the protective effect. But the extension of the rebates on parts tariffs tips the balance in the other direction in our calculations. I do want to say there's a very wide uncertainty band around these calculations. And of course, I already mentioned that we expect the tariffs to add more than $3,000 to the average price of a vehicle. So from a consumer perspective, we expect the tariffs to impose substantial costs. But we do estimate that right now they will slightly increase domestic auto production over a period of several years. So after the supply chain has had time to adjust. Okay, so turning to light vehicle sales now, the national sales pace finished at 16.2 million units last year, but sales dropped in October after the EV tax credit expired. We expect light vehicle sales to stay pretty steady from here. So that's the yellow line here. I don't know why I'm so bad at this. I swear I used to be better. But yeah, here we go. Thank you, Daniil. So that's the decline. You can see just the dip in the yellow line. That was the expiration of the EV tax credit. And then you can see the yellow line stays pretty flat from here, averaging just under 16 million units per year through 2028. And I already noted that we expect the elimination of CAFE standard penalties to boost the Detroit 3's share of the market relative to the trend. But I should also point out that the trend has generally been downward. The Detroit 3 share had declined in 21 out of the 25 years before 2025. Last year, though, the Detroit 3 share of the market rose by nearly a percentage point, and we expect it to rise a bit further this year before resuming a gradual decline. Detroit 3 unit sales rose from 5.4 million in 2024 to 5.7 million units last year, and they edged back down to about 5.5 million by 2028 in our forecast. So moving to employment, this slide shows you our forecast for the level of payroll employment in Michigan through 2028, along with the history going back to the start of the 2000s. And I already mentioned that Michigan's payroll job count did pretty well last year, at least as the data is currently published. So if you look at, the vertical line that kind of denotes the latest data, you can see that there was a pretty healthy rise just before the rise for the most recent data, the line for the most recent data. And we've penciled in 39,500 job gains for 2025, but we do expect growth to slow down sharply this year. If you heard me speak in Detroit on Tuesday, we've updated our projections slightly for the CREC, so the numbers I'm presenting today are new. We now project about 6,000 job gains in Michigan this year, picking up to about 15,500 per year in 2027 and 2028. Our projection for this year is now a little bit stronger than what we estimated in November, which were the numbers I shared in Detroit on Tuesday. And the reason we've updated our projection for this year is not because we've changed our growth expectation during the course of 2026. Instead, it's that growth came in a bit stronger in the most recent data for last year. And that mechanically pushes up the calendar year average growth rate for this year. Measuring from the end of 2025 to the end of 2026, we're projecting payroll employment to hold essentially flat in Michigan. But growth then does pick up as we move into the back half of the year and into the next couple of years. And our forecast takes Michigan's payroll job count to 2.8% above its pre-pandemic level by the end of 2028, although it remains about 2.7% below its all-time peak from the second quarter of 2000. And I won't get into all of the individual industries in our forecast today, but I did want to give you a little bit of the logic for our forecast. And so here I've broken down all of Michigan's industries into two groups, what we call the cyclical industries in the yellow line and what we call the non-cyclical industries in blue. And without going into the complete definitions, the non-cyclical industries are primarily service sectors such as government, healthcare, leisure and hospitality, and things like that, whereas the cyclical industries include sectors such as manufacturing, construction, finance, and business and professional services. Employment in the cyclical industries in the yellow line tends to move much more closely with the business cycle than in the non-cyclical industries, and that's why we gave them those names, although you can obviously see that both industries lost quite a lot of jobs during COVID, so that was the exception. So in our forecast, the cyclical industries eke out about 1,500 job gains this year, although manufacturing loses about 200 jobs, so it holds about flat, and professional and business services loses about 2,500 jobs. The cyclical industries then add about 4,900 jobs next year and 6,900 in 2028. But you can see it, holding roughly flat during the forecast. So really, the job growth that we're projecting is driven by the non-cyclical industries in the blue line. We're projecting growth of about 4,600 jobs this year in the non-cyclical industries, which picks up to an average of about 9,600 jobs per year in 2027 and 2028. One reason we're not more optimistic about these industries is the tough funding landscape for the health sector, which has been a job engine here in Michigan, and I already noted. So moving to the unemployment rate, our forecast has some ups and downs. This graph shows you our forecast for the unemployment rate in Michigan. But the reality is, in the grand scheme of things, we're projecting unemployment to hold roughly flat. It hovers between 5 and 5.5% throughout the forecast period. And this slide shows the labor force participation rate here in Michigan. And I've already talked about the interplay between the unemployment rate and the labor force participation rate. Something I think that's not always appreciated is that we really did get a very strong recovery from COVID in the labor force participation rate. And then labor force participation held roughly steady for about a year and a half. But as I mentioned earlier, it dipped over most of 2025. And I should say, it took a while to get that recovery from COVID. There were a lot of think pieces about why aren't people coming back, but they eventually did come back. But now, of course, they're leaving again. And as I mentioned, the decline in labor force participation has kept a lid on the unemployment rate, even as the household employment count has been falling. We do expect this decline to continue at a relatively gradual pace as demographics work against us. The labor force participation rate dips from 62% early last year to about 61% by the end of 2028. And the share of Michigan's population aged 65 or older rises from 19.9% in our forecast to 21.3% in that same period. So, this is really, it's about the demographics and the aging workforce. So this graph shows you our forecast for Michigan's personal income per capita in yellow and real disposable income per capita in blue. So personal income per capita in Michigan has more than doubled since the year 2000. It grew from about $30,200 in 2000 to $63,700 in 2024, which is the most recent complete data. We're forecasting growth of nearly 4% last year to slow down to the low 3% range over the next few years, which brings personal income per capita to about $72,700 in 2028. So that's the yellow line that's not adjusted for inflation. The blue line, real disposable income per capita, combines our forecast for nominal personal income in yellow with our projections for personal taxes and local inflation, the Detroit CPI. In 2024, real disposable income per capita stood about 26% higher than in the year 2000, but it was still more than 5% below the stimulus yield level from 2021. We actually estimate a growth of 1.5% last year, which would be pretty healthy from a historical perspective, with decent payroll job growth and low inflation. But growth slows to around 0.1% this year as job growth slows down and inflation picks back up. Growth in the blue line then picks up to an average of about 0.5% per year in 2027 and 2028 as job growth firms up and inflation cools back down. In 2028, we project Michigan's real disposable income per capita to stand almost 8% above its 2019 level. Okay, this slide shows you our forecast for state tax revenues, and I'm gonna do the lightning round version because I know we have the deep dive coming up. But this is our forecast for state revenues for the general fund in yellow and school aid fund in blue. Over the past 3 years, combined revenues have pulled back from their pandemic-era highs, largely due to changes in the state's tax laws. The recent volatility has been concentrated in the general fund, while the school aid fund has stayed more stable. The books have not been officially closed yet for fiscal 2025, but current tracking suggests the school aid fund will show revenue growth of about 2.7%, while the general fund grows by just less than a percentage point. Looking forward, we expect 3 more years of fairly weak revenue growth in these two funds for the state, with combined revenues growing by 1.1% in fiscal 2026, 1.3% in fiscal 2027, and 2.8% in fiscal 2028. That weakness, however, is less related to the underlying economic trends and more related to legislative tax changes. And you'll hear more about this later this morning from our colleagues, but some of the largest changes include changes to the taxation of motor fuel purchases, the new deduction for qualified tips and overtime to match the federal changes under the Big Beautiful Bill, and also the repeal of the personal income tax earmarked to the Michigan Transportation Fund, and its replacement with new and larger transportation earmarks on the corporate income tax. Without these changes, we would be projecting average combined revenue growth of just under 5% for the next 3 years. Importantly, the school aid fund, again in blue, is insulated from many of these changes, as the figure on the screen shows. Although sales tax revenue is expected to decrease from the changes related to motor fuels, the school aid fund will receive transfers to be held harmless for the change. So, policy changes are obviously impacting this forecast, and I know we have an entire presentation on this coming up, so I'll pause here for now. But I'm obviously happy to talk a little more, at the end if there are questions. Okay, so I did want to just take some time to talk about wages here in Michigan, because obviously wages are a key driver of tax revenue. And, at our conference last year, at our Economic Outlook conference, we took a deep dive into how wages in Michigan relate to the nation and some key comparison states. And so, I think sometimes this is underappreciated in Michigan, but over the past 3 decades, Michigan's real wages have deteriorated sharply compared with the United States. We've lost ground relative to the nation and some key comparison states. In 1990, Michigan's average wages stood 9.5% higher than the U.S. average after adjusting for the cost of living, and that was the 6th highest in the country. The situation had reversed by 2024, which is the most recent year for which we have complete data. Michigan's adjusted wage had fallen to 4.2% below the national average, despite our relatively affordable cost of living. This graph shows you cost of living adjusted real wages for Michigan, the United States, and 3 comparison states, which we chose to be Massachusetts, Texas, and North Carolina. And so if you look at the beginning of the graph, Michigan's adjusted average wage was nearly identical to Massachusetts's. And we were running about 15 to 16% ahead of Texas and North Carolina, and we also led all other Great Lakes states at that time. By 2024, our adjusted average wages were 18% below Massachusetts's, 8% below Texas's, and 1% below North Carolina's. And we were roughly in the middle of the Great Lakes states as of 2024. Right, so just, Michigan is in the blue line, and the basic point is we have seen real wage growth, but at a slower pace than the nation and these comparison states. And so we wanted to study why has this relative deterioration occurred. And so this graph breaks Michigan's wage differential into several parts. The details are in our forecast report for Michigan's economy from November, which is up on our website, and I'll have a QR code at the end of the slideshow for our website, but for now I'll just provide a brief summary. The purple bars, which are actually hard to see, show what we call the employment mix effect, which asks how much of Michigan's wage differential can be explained by having a different industry mix than the national average. Obviously, we have more manufacturing here than the national average. And it turns out the answer is that does not explain very much of our wage differential. The other colored bars show how much of the overall differential comes from our wage advantage or disadvantage within major industry groups. And it turns out there are 2 major parts of the story of Michigan's declining wage premium. In 1990, our blue-collar industries paid an average of $11,500 more than the national average, adjusted for inflation, so in 2024 dollars. And that was the major reason Michigan was a high-wage state. So just looking at the left-hand part of the graph for the 1990s, the big blue bars are saying we paid a lot more in manufacturing. We're basically scaling that by the relative size of manufacturing in the state economy, and we're saying, that's why Michigan was a high-wage state. Since then, our blue-collar wage advantage has eroded substantially, over 2/3, to about $3,000 relative to the nation. So that's on the right-hand side of the graph. And because blue-collar employment is less than 1/3 of the total contribution of that wage advantage in manufacturing, and I shouldn't say manufacturing, but blue-collar industries more broadly, is less than $1,000 now. At the same time, a large wage disadvantage has opened up in our higher educational attainment services industries, which are basically private sector service industries that typically require a bachelor's degree or more education. And that's in the gray bars. So if you look in the 1990s, the gray bars are at the top, and they're generally relatively small, but they're positive. And then if you look in the 2020s, we've got these big negative gray bars. Right, so the wage differential in these higher educational attainment services industries has swung from a small positive in the 1990s to a large negative today. And Michigan trails the national average wage in these industries by $11,000. So, Michigan's economic history has been rooted in strong blue-collar industries, and we should be very proud of that. We basically invented the middle class here in Michigan, but we have faced a tough transition to the knowledge-based economy. And so to return to the ranks of the most prosperous states, we really do need to increase employment and especially wages in these higher education, high-wage industries. And I know I'm probably biased because I work at the university, so I always, offer that disclaimer. I think that's, fair to observe. But, from my perspective, that does mean helping more of our young people to get bachelor's degrees or even more education, and also finding ways to keep more of our college grads in the state. So just to wrap up, we're forecasting employment in Michigan to grow by roughly 12,000 jobs per year through 2028, although with a soft patch this year. Our unemployment rate hovers between 5 and 5.5% throughout the forecast period. Growth of real disposable income per capita averages about 0.4% per year. And combined general fund and school aid fund increases by about $1.8 billion from fiscal 2025 to fiscal 2028, although obviously there's lots happening underneath those totals. So with that, I'll wrap up, but I did promise you QR codes, so if you want to go to our website or subscribe to our forecasts, you can do that with these codes, and Daniil and I will be happy to take questions if there's time. So thanks very much.
Thank you very much. So pretty much this is a ho-hum kind of forecast is what it seems like. But something I keep hearing, and Daniil, you brought it up, was the resilience of the consumers. I hear it all the time. Can you talk a little bit more about it? You just kind of used the words in passing, but it feels like that's, everyone's saying that's keeping the economy kind of propped up at some level. Any insights?
Yeah, I mean, there's a lot of talk about the K-shaped consumer. So the stock market valuations are definitely helping the more well-off to keep consuming. So if there were a stock market crash, obviously that would change. But as long as stock valuations and portfolios keep going up, a good chunk of like overall consumption is going to keep growing. There were cost pressures, but the pass-through of tariffs into consumer prices has been quite muted compared to some early estimates. So that's also helping. And while the the number of job gains are not spectacular, unemployment rate is holding, and more importantly, wages and real wages are still rising. So people are getting larger paychecks and they spend it. So as long as the labor market at least keeps stable and wage growth continues, there will be spending power. So there are definitely metrics that say that the people on the lower part of the income distribution are suffering more. But to be honest, that's usually the case. And as I said, the stock valuations are supporting more higher net worth consumers and their spending.
So my question was similar to Mary Ann's in that, I mean, Daniil, you also touched on, you saw some stability in the delinquency rate related to, revolving credit. So are we still seeing revolving credit and other types of borrowing to prop up consumer spending continuing to grow and just delinquencies are falling? Or has that also stabilized?
Right. So there are several measures of delinquencies. Some of them are still edging up. So like longer term, like 90-day serious delinquencies are maybe edging up, but new delinquencies are stable to slightly improving for like consumer credit type loans, so credit cards and auto loans. And that's basically telling us that perhaps the shape of consumer is not as, precarious that some people think. And I mean, just looking at some consumption metrics, they are pretty respectable. Vehicle sales recovered in December. Retail sales keep going up at, 5-6% clip year over year, and we're not seeing much acceleration in inflation. That means that real retail spending is still growing. So people are upset about everything, but they're keep spending. So maybe it's a way of coping.
Yes, thank you. So you talked about the unemployment and people seeking jobs. So do you think the new work requirements in Michigan will have any impact on that?
With respect to Medicaid eligibility, we have not, I think the most straightforward way to answer that question, we have not factored that into our forecast explicitly, is what I would say. The numbers, I might have some numbers here on how many people could be affected. And I think one thing with the, let me see if I cut the estimates of work requirements because it's a wide range of people who will be affected, in the estimates by the work requirements for Medicaid. I do think, one thing that you hear about that is that just the paperwork itself can sometimes be a little bit confusing with the work requirements. So, do I think that will move the participation rate, in a really measurable way? I'm not certain, but it's not something that we built in directly to the forecast.
So in the future, with the work requirements, it does allow for people to either be doing volunteer work versus actual seeking employment or having employment. So will you, in the future, be factoring that in, some way to distinguish that? Because it seems it would be important.
No, it's a great question, and we will absolutely take a look at that. As you say, you don't necessarily have to be working for a paycheck or you even self-employed. So that does affect, whether you count as employed in that data. So we'll take a look at that. That's a great question.
Thank you.
Yeah, thanks.
Thank you.
Thank you so much, as always. Thank you.
Thank you.
All right. We are right on time. Our next presentation is The Economics of AI, a Brief Tour. And we would like to bring up Dr. Justin Wolfers, Professor of Public Policy and Economics at University of Michigan and a visiting Professor of Economics at the University of Sydney. He holds a variety of affiliated positions with institutions such as the National Bureau of Economic Research, Brookings Institution, Peterson Institute for International Economics, Institute for Study of Labor in Bonn, the Center for Economic Policy Research in London, and more. He's previously taught at Princeton, Wharton, Stanford Graduate School of Business, and been an economist with the Reserve Bank of Australia. Dr. Wolfers earned his PhD in economics from Harvard, was a Fulbright, Knox, and Menzies scholar, and on. Earned his undergraduate degree in economics in his native Australia, and winning University Medal. And so, again, I have more bio if people are interested, but we are very excited to have you here. Thank you for coming, and I'll turn it over to you.
Well, thank you. This is actually my first time in the Capitol. So what a beautiful place and what a joy to be here and what a joy to join you. I think I'm pretty much here as the light entertainment. So we've got people doing real revenue estimation. And so maybe there's some input here that'll help you as you think about the longer run future. In some sense, actually, I think there is because AI kind of matters. And for those in the audience who were at Treasury Eubanks earlier conference, I apologize, you'll hear me twice. So we're on the cusp of something that seems pretty interesting. And so we could spend days talking about the future of AI. I'm going to try and give you a whole lay of the land very quickly. So as an economist, I could start by thinking about the microeconomics of AI. How will it affect you and I or individual workers, individual firms? Let's do that. And then I could follow my RSQE colleagues and we could talk about macroeconomics. How does this all add up? Now, of course, there's a direct link. The macroeconomy is the sum of what each of us does. So we'll work from one to the other. And given that we're in the Capitol, it makes some sense to ask this harder question, which is about the political economy. I think that if we do change, if we bake more economic cake, there are questions about how we slice it up. And I think these are actually really very fundamental questions and fundamental to thinking about AI policy more broadly, if, of course, the federal government allows states to have any views about it at all. And then we'll see how we are on time. If we're here on time, I'm going to do something quite unusual for this room, which is give each of us personal advice for how we can become more productive as in the work that we do, how we can adapt. But we'll see how time goes on that one, because it feels less serious than this room feels. This room feels very serious. So look, why are economists excited about AI? Why are people excited about AI? So I'm just going to start with case studies. We have to work with case studies because we don't have an example of a major economy that's fundamentally adopted AI yet. What we do have is small studies about what adoption of AI can do. So the first was a study where basically they did what doctors do. They ran randomized control trials. Heads, I ask some workers to use AI in their work. Tails, I tell them to do their work the way they normally would do it. And then we can just compare the two to see whether this drug, this miracle drug AI, does what it's meant to do, which is cure the illness of being unproductive. So what did they do here? This was about coders. Coders are asked to do a simple coding task. If you got heads, you were told, do it the way you normally would do it, which is, if you're stuck, check the internet, check Stack Overflow, just however you normally do your work. And if you got tails, you were told you could use GitHub Copilot, which is just one of these large language models that's out there. This fairly straightforward task, if you were in the control group doing it the old-fashioned way, it took 161 minutes. If you suddenly got access to AI, it took you 71 minutes. That is a 56% improvement in productivity, right? Let me just put this in context. Typical productivity growth in the US economy in an individual year might be 1%. So this is a generation's productivity growth. for this particular firm, for this particular task. That's just one case study, though, and this is coders, and one thing we know about AI is it's really good at writing code. So let's think about the sorts of work folks in this room do. So this is for office workers. So think about the stuff that office workers do. Maybe not the people in front of me, but the people behind me. We do things like write press releases, short reports. We write analysis plans. We have to sometimes write a delicate email to an underperforming staff member. You know, just the stuff white-collar workers do. For the folks who got heads and were told to do it the way they normally would do it, it took 27 minutes to complete this task. For the folks who were given access to ChatGPT, it took them 16 minutes. That's a 40% rise in productivity. That's not the whole story. The folks in the treatment group, that is the folks who used AI, not only did the same quantity of work, it turns out it was higher quality work. So you have people read the work of the white-collar workers, and they said, wow, I really like the way you told this staff member they weren't good at their job. And by the way, this is an experiment done with ChatGPT 3.5. We're now at 5.2. The worst chatbot you'll ever use is the one you used yesterday. So realize in some sense all of this is understating the gains. The next experiment is from a real company. This company, you could think about it as sort of like a customer service stuff. You know, when something goes wrong, you call the airlines and you yell at someone or they yell at you. Well, of course, the way this is done more often now is with chat. You know, you chat to a customer service agent. What they did in this case was there's a bunch of people in front of computers answering these support requests. And they could do it, the group with the blue bar did it the way they normally would. The group with the red bar, they added basically a chatbot that would read the messages coming in. And for the customer support agent, it would suggest you could reply this way. Didn't tell you had to. So it was just like, you do it the way you normally want to, or here's what I'd do, and I'm a computer. And it turns out that led them to resolve the issues 14% faster. One of the things that's true across all of these studies is that they helped low productivity workers more than they helped high productivity workers. So people who are already really good at their work, not a big help. People who were less good, a much bigger help. And if you think about that in terms of inequality, that's quite interesting. Inequality within a workplace, this is an equalizing force. Okay, that's pretty interesting. But, you know, we're used to thinking about technological change. We're in a constant state of flux. In Michigan, we've seen automation transform many of our industries. What's new here? And I think what's new here is actually something quite fundamental. We have had many, many technological revolutions, but almost every single one of them has been a replacement for brawn. So I want you to think about the work that humans do as being brain and brawn. If you think about robots, robots are brawn. If you think about the invention of farm equipment, that's brawn. And so in the past, technology has been a replacement for brawn. This is the first time I can remember, with maybe the exception of the PC revolution, that we're talking about something that's potentially a substitute for brains. So this is a machine of the mind. It's affecting cognitive work. And so every other time you've ever thought about technological change, you've probably been thinking about blue-collar workers. And the thing to understand is this is a white-collar revolution. So for me right now, let me tell you my job. My job is I read widely in economics, and I know a little bit about a lot of things, and then I turn it into straightforward English. Guess what AI is really good at? All of those things. So for me as a white-collar worker, I feel like a Detroit auto worker in the 1970s. I feel the robots coming for what has been historically my craft. When I look around this room, I think that's basically true for all of us. So the point, though, is think white collar, not blue collar. Okay, so who's vulnerable? There are studies where folks have gone through and they've read, like, what is it different people in different occupations do? And then they've tried to figure out, for those occupations, how many of the tasks that people do could be automated. And so you could imagine lining up all of the jobs that exist in the Michigan economy, from those which can't be automated at all to those that could be completely automated. So the two extremes here are what can't be automated at all. Professional athletes, right? So if I'm going to give you career advice, surviving the AI revolution, become a professional athlete. Short order cooks can't be automated either. You'll notice here, actually, I've said tradesmen's helpers can't be automated. Tradesmen can, right? What's going to happen is the plumber is going to walk into your home, pull out his or her camera, take a photo of your pipes. The AI is going to tell the tradesman what to do, and then they're going to tell their helper actually how to fix the pipes. So it really is purely physical labor, which is completely un-AI-able. The opposite extreme are the tasks where all of the jobs where all the tasks can be implemented. And so I think it's no exaggeration to say the last translator has been hired. And I'm not pushing my kids into that field. But there's a lot of other things that are like that. I work with copy editors who put more semicolons in my work. ChatGPT is really good at also adding M dashes as well. Web designers, web pages now can be designed into 2 lines of conversation with a chatbot. So those are the extremes, but that's where not much of the Michigan economy is. And the question is, where's the rest of it? And so what I want to do is just make the case that the AI revolution is relevant to most workers. So by relevant, let's set a threshold. If 1/10 of your work could be automated by AI, I'm going to call it relevant. And so this says 80% of American workers are in jobs where AI is relevant. What about dominant? Well, half of American workers are in jobs where half of their tasks could be automated. Now, to be clear, I'm not saying that their job is going away. I'm just saying half of their work might be done by the computer. And the question is, how do you fill in the rest of your day? Okay, that's the microeconomics of AI. So we see how it affects individuals at work, we see a little bit about who it affects, and we see some of what those effects are. Now, in this room, it seems we talk more about macroeconomics, so let's add all those pieces up and say, will this fundamentally transform our economy? If so, how? That's my next job. So here's just a very simple framework, and I think it's too simple, but what's useful about it is it's a way of doing arithmetic, and arithmetic's a really powerful force for economics. Here it says, what I want you to do is think about the American economy as a collection of tasks, right? So one task is sitting through a hearing, which you're doing an amazing job at. A guess, this comes from Daron Acemoglu. Daron won the Nobel Prize a couple of years ago. Daron says AI could, one estimate, based on the sorts of things I was showing you earlier, is of all the workplace tasks done in the US economy, one estimate is 20% of them could be done by AI. Fair enough, that seems plausible. But he says, just because something could be done by a computer doesn't mean it should be done by a computer. The question is it going to be cost effective to have it done that way? His estimate, and I'm going to come back to this, is that only about a quarter of those tasks could be cost effectively automated, right? This might explain why in some of your own offices you've been a little reluctant to go all in. You think that the quality control and so on is that it's not that worthwhile. So if you multiply those numbers, that says 4.6% of all tasks will be done by AI. That's not the whole story, though, because just because it's done by AI doesn't mean there's no human input. So if you automate a task, maybe that yields, remember I showed you like 40%, 56%, 14% labor savings. Well, let's just pick a number from the middle. The number from the middle is 27% labor saving. So if now we've only got 4.6% of tasks getting a 27% labor saving, now we're down to a 1.2% reduction in labor costs. This is enough that if you're running a business, you'd care about it, but if you're forecasting the future of the Michigan or American economies, you would sort of like, who cares? So let's try and just quickly do the rest of the work to turn this into a forecast for GDP. Now, we managed to get rid of 1.2% of labor costs, but labor is only about half of the economy, so then that scales to 0.66% of production costs. Alternatively, you could call this a 0.66% rise in total factor productivity. Now, it turns out in order to have a whole bunch of AI, we're going to need a whole lot of data centers, right? So in order to get this rise in productivity, we have to build a bunch of stuff. And GDP counts investment. So it counts building a data center not as a cost, but as a benefit or as part of production. So I think the benefit is the reduction in production costs, but if you think about what this does to production, there's the extra production plus the data centers. And so if we had a proportionate increase in capital investment multiplied by the capital output ratio, all of that says you can add all the pieces up and you get to a 1.1% rise in GDP, and this is roughly looking ahead over a decade. So this is enough that Gabe and his colleagues, they'll make sure to factor it in case there's pointed questions, but it's not going to fundamentally transform anything. But this is only one way of telling the story. So what I've done here is I've actually told the pessimist story, and I've told it the most realistic way I can to say there is a realistic way to get to say this isn't big. But I don't think this is the whole story. So here's an approach from Goldman Sachs, which just takes the exact same framework and just tweaks a few things. Instead of saying AI could transform 20% of all tasks, let's make it 25. Instead of saying it's only going to be cost effective to automate 23% of them, one of the things is the cost of AI is plummeting at an extraordinary rate. The AI services, you start using, dollars per token, it falls by 50% every 6 months. So extraordinary rate of improvement. So maybe anything that could be automated is going to turn out to be cost effective to automate. They think that automation yields a 36% labour saving instead of 27%. You saw the studies, they're all over the shop. Any guess is as good as any other. But all of a sudden now we've gone from a 0.66% rise in labour productivity to 4.7%. This is the point at which my friends in revenue estimation would start to lean forward and say, hey, maybe there's something here, maybe we ought to be thinking about this. So this would be an 8% rise in GDP over the next decade, above and beyond whatever you sort of had built into your pre-AI forecasts. Okay. Still, there's a lot missing. I don't think this is the whole story at all. So remember, what we're doing here is we're taking all the tasks in the economy and we're thinking about what happens to those tasks that could be done by AI, and I've been focusing on the displacement of those tasks. In this framework, displacing tasks to a computer is good, right? It frees people up to do other things. But what we're missing here is there's a whole bunch of other people beyond those who, narrowly speaking, will have the set of tasks they do change. And there's a bunch of studies that seem to show that when firms adopt AI, they subsequently get substantially faster AI growth. So there are effects above and beyond the arithmetic that I'd been describing earlier. That's the point I want to make here. Here's the one I really want you to focus on. So let's go a long way back. What is it that causes economic growth? So in this room, because we're often focusing on next year, we're thinking about business cycle factors, monetary policy, fiscal policy, and so on. I want you to put those aside, because what we want to think instead is, what is it that makes some countries richer than other countries? Or what is it that causes long-run economic growth over a period of decades or centuries? And the best answer that economists have is that it's new ideas. New ideas are what ultimately created things like the personal computer, the technological revolutions that have driven economic growth through time. So what if AI raised the productivity of innovators? It would be like getting a whole bunch more research and development just for free. And if innovation is what drives economic growth, then AI, by boosting the productivity of innovators, boosts economic growth. So if we could boost the productivity of innovators by 20%, that would raise the underlying rate of productivity growth of the American economy from 2% to 2.4%. That sounds small, but remember the magic of compound interest. And so the magic of compound interest would mean that by the year 2060, GDP would be 30% higher due to this channel and this channel alone as a result of AI than not. So now we're starting to talk about stuff that really matters. So stuff's adding up. And so let's try and add everything up. So what I began with was talking you through the logic of this smallest, tiniest little bar on the far left here. What is the effect of AI on GDP over a decade? Acemoglu says around about 1%. But it turns out if you go up and down the street, the sorts of people who are meant to make up numbers and present them to legislators, or Wall Street, they have much bigger numbers. And they have much bigger numbers for the reasons that I just described. So on average then across all of these groups, they're saying over a decade, the level of GDP would be 12% higher, or annual growth would be around about 1% higher. I think this is a number that I can defend. I think you've also seen lots of reasons why you could believe smaller numbers, and you could also think fairly easily about reasons why you could believe more dramatic numbers, particularly if you see big effects on innovation. But at least this is a starting point. Now, what's built in here and what are some of the important risks? So the most important thing is that whenever people are talking about AI at the moment, they're saying, well, we just invented this new technology, it'll transform business tomorrow. That's not historically how technological revolutions have worked out. So let's go back to the invention of the steam engine, which kicked off the Industrial Revolution. It did not cause immediate economic growth. We had a 50-year period of reorganization where we had to accumulate capital in ways that used this new technology. And in fact, if you've seen any, if you've read any literature of the period, people were miserable through this period. It took 50 years for the steam engine to transform the economy. We could move forward to electrification. Electrification is an enormous change in how we can organise manufacturing, for instance, but it didn't really boost productivity for 30 years. And the reason is that factories were designed for the pre-electrification era. And as a result, adding electricity to a poorly designed factory didn't do much for you. You had to rebuild or redesign your factories. There was a period that some of us may recognise, which is the personal computer revolution, particularly in the 90s. We all thought there were computers on every desk, and therefore we'd all become more productive. And it turns out you could see computers, Bob Solow once said, everywhere except in the productivity statistics. And again, it turns out you've got to reorganize work. You have to, I think most of us in this room write our own correspondence. So as while you've still got the typing pool, you're not getting the productivity gains. And so it took 15 years for computers to boost productivity. And so the big question is, this revolution, is it going to be a revolution that does play out over the next 10 years, or is it going to be much longer? So here, I think people are talking as if this is something that plays out in a very short period of time. History suggests that's a little bit optimistic, but there are reasons to be optimistic about this. So there's something different about this revolution than others. So the first is AI is software. It's just bits and bytes. There's nothing physical about it. There's no plant we have to reorganize. The second is it's inherently built to be modular. So if you haven't coded before, this will mean little to you. But an API is an application programming interface. Let me say it in English. Even an economics professor can learn how to reorganize his work using this. It's very plug and play. It's designed basically as a Lego system. And so whatever computer systems you currently have, your computer nerds should be able to just plug into it very, very easily. The third is, if you think about other things, they're sort of complicated, right? The personal computer, you had to learn how to use something totally different. AI speaks to us in our language. And so our ability to harness and use this technology is fundamentally different. Now, there are huge policy issues that still remain, and some of them may slow AI adoption. So in Washington, people talk a lot about the chip shortage. We're worried about energy bottlenecks because data centers use a lot of energy. And regulation, or the lack of regulation, could turn out to be something that really slows the adoption of AI. So, will this change the world? I'm kind of confident, yes. When? Who the heck knows? Let me say a little bit more about timing, which is actually the current rollout of AI in the United States is remarkably slow. If you talk to the Silicon Valley folks who think this is extraordinary, or if you said, I just found a technology that can make your workers, let's say, 25% more productive, you would think every employer on earth would be fundamentally adopting it tomorrow. And honestly, I've done that in my own work, but I'm struck when I walk around the university or around the real world how many people still prefer to think for themselves. So here we have data that suggests that roughly 10% of American businesses say that they've adopted AI. Another 14% suggest that they're going to do so within the next 6 months. And I mean adopted at a fairly fundamental level. Most people, when they go to work today, their work looks a lot like it did 2 years ago. And so that's why we're not going to see it in the productivity statistics, because work hasn't been redesigned. The survey I drew this from says that Michigan's numbers are roughly similar. I would emphasize the rough similarity more than I would emphasize the fact that we're slight laggards. And I felt really bad when I drew this graph and everything came out green. So I had to write go blue there as well. So I think what this says is don't go looking for the effect of AI in current data. People are looking, and when you look for things, you find them, but they're not. I don't really think it's there very much. Okay. Let me also just give you some advice for how to think about or navigate the conversations and debates that you'll hear about this. What's kind of striking is the answers you get depend on who you talk to. So if my better half, she's on the board of Lyft, which is a tech company. She flies out to Silicon Valley with some frequency, and she talks to, the tech nerds who wear vests that say Patagonia on them. She talks to them. And what's amazing is you talk to them and you say to them, like, what's going to happen to GDP growth? And they're like, it's going to be 40% next year. It'll be 50%. We are on the cusp of a total revolution. And then you go and you talk to AI economists who are the most optimistic of all the economists, and they say, GDP growth will be 1% higher. Can you believe it? What a time we're in. So we get very, very different language. Now, here's a moment actually I want to be humble, which is the AI guys could be right. Like, they understand the technology. All that I know is that past technologies haven't done this. But the idea that the computer can more or less think the way we do and do most of our thinking for us is kind of amazing. And the idea that we really are at the point where the computers are now, most of the code that Anthropic has is written by Anthropic's programs. So you have capital creating capital. Imagine if we had a robot that could invent robots, right? Wouldn't that be amazing? And that's sort of what they're thinking about. So I'm not saying they're wrong. Now, by the same token, they're not very good at economics. So I'm not saying they're right either. I am just giving you a way, I think, first of all, of understanding the debate and understanding, you'll speak to different people, they'll use very different language. And so one thing is to ask, where are they flying in from? Are they flying in from the West Coast or the East Coast? Because you'll get very different answers. And then the other is to, again, understand just how unknown all of this is if you think there's anything to wearing to the West Coast guys. Okay, that's the macroeconomics of AI. Let me talk a little bit about political economy, and I think that's where this is closer to the work of legislators, because I think this is an underappreciated issue, which is, let me preview the message I want you to get from this. Small changes in regulation could have enormous effects on how this plays out. There are scenarios it's quite easy to think of as being dystopian and scenarios that are utopian, and very, very small changes in the rules of the game could separate dystopia from utopia. So, so what do we have? The macroeconomics of AI tells us the pie just got bigger, and the question is who gets what pieces of the pie. And the following is really a thought experiment, but it's, I think, meant to highlight a really important issue here. So what I want you to do is imagine that when I came up here today from Ann Arbor, I brought each of you a robot as a gift. And maybe you're allowed to accept gifts, I'm not sure, but I brought you a robot, and I said, here's a robot. It's the, what do we call it? The Lansing 2000. Right? So the Lansing 2000 is amazing. It can do all of your work for you. And it's my gift to you personally. You get to keep the Lansing 2000, right? And then the question is, are you better off? And I think the answer is overwhelmingly yes, which is what you would do is every morning you'd pack your Lansing 2000 off with its lunch and a sandwich and a cup of coffee, and it would go into the Capitol and do your work for you. And then you would do the things you truly love. Right? You would hang out with friends, you would go to the beach, you would write poetry. Is your boss better off? Well, the work's getting done, and your boss is still paying you the same amount to get it done. So you're better off because you're getting paid, but you're not actually having to work. Is your boss better off? Well, they're not better off, but they're not worse off. The work's getting done and the same amount of money's going out the door, right? Of course, the robot here is a metaphor for AI. Now, I want to make one tiny tweak really small tweak to this thought experiment, which is I come up here and instead of giving you the Lansing 2000, I call your boss. And I say, hey, I got a Lansing 2000 here for you. The Lansing 2000 can do all of the work your current staff does. So same robot, same gift giver, same gift given, but it's given to a different person. What's going to happen now? Well, your boss is going to say, well, this is terrific. I can fire all my staff because they cost me so much money, right? But I'm still going to get all the work done. So now your boss is enormously better off, but you're worse off because your boss just fired you, right? Because the Lansing 2000 is doing your work. So this is dystopia. The previous one was utopia. The thing to understand is the thing that separates utopia and dystopia here is not the presence or absence of AI. Both of them have the Lansing 2000. The thing that's different in the two scenarios here is who owns the robot. And so we don't have a robot problem, we have an ownership problem. Right, and so you could think about, so this is a metaphor I want you to apply when you start to think about AI. Because if the boss owns the AI, we're screwed. And if you own the AI, life's great. You're writing more poetry, right? Okay, so that's the first idea of one small tweak on how this technology plays out that has a huge difference. But it's not the only one. I'm going to give you two more ways in which you might think about it. So we're currently in this very fortunate world that the provision of AI services, that's a market, and there are many, many competitors. There's OpenAI, Google Gemini, Claude, and so on. And they're competing against each other. And what do we know about markets with competition? We know that they tend to push prices down. They tend to push prices towards marginal cost. The marginal cost of a computer thinking is awfully close to zero. So what that means is that the AI services are being offered at a price that's very, very close to zero, very low compared to hiring humans. Okay. Now, each of these companies is offering services that could do your job. Who's going to end up better off as a result of this? Well, now, this is like giving your boss the Lansing 2000, which is your boss now can buy AI services that do your job at a price close to zero. So the boss is enormously better off, and guess what? You just lost your job again, okay? I'm honestly a little surprised that this market has turned out to be so competitive. The best AI service literally is changing month by month. You could imagine we have lots of other markets where it's turned out that there's been a monopoly provider that's ended up on top. Think about search. Everyone uses Google, right? Anything where there's any sort of winner-take-all nature to the market can cause it to tip towards a monopoly. You'd have to think really hard about this technology to know if there's a winner-take-all aspect to it, but you could imagine that the service that gets the most use then has the biggest training corpus, which then gives it the most use, and so on. So you can imagine Google actually being a lot like search was. So now I want you to think about, we move forward to a world in which there's a monopoly provider of AI. Well, your boss calls them and says, I want to fire my workers, I don't like them very much. And the monopoly AI provider says, yes, well, you currently pay your staff $1,000 a week. I will sell you the AI services for $999 a week. They're a monopolist. They can get away with that, right? And so now we're at a point where the boss then will spend $999. You lost your job. The boss only made a $1 saving, and OpenAI just made $999. So now we're at a world in which, yes, there's enormous gains to GDP, but literally 100% of them go to OpenAI. And so this is a completely different dystopia. This now is a dystopia in which our future overlords, the owners, is the monopoly firm providing AI services. So here again, the problem is not the presence or absence of AI or of robots, but the market structure in the market for AI. And it suggests that preserving competition is wildly important. Now, I can give you one more example. Here I've thought about the monopoly provider as being the monopoly provider of AI services. Now, we're in a world in which there's many AI companies, but they all need NVIDIA chips. So now we have a monopolist upstream. And you can actually so what's going to happen is your boss is going to say, I currently pay my workers $1,000. So then they'll say to the AI services, I'm willing to pay you $999 for AI services. And they say, well, I'd love to do that. I need to buy some chips from NVIDIA. And NVIDIA is going to say, I'm going to sell you the chips you need for $998. Now all of global GDP goes to NVIDIA, which, by the way, is now the largest company in the world. And so again, if there's a bottleneck at any point in the AI production process, that monopolist ends up owning all of GDP. All of this is just to say that regulation can have enormous effects on where we end up. Remember, we started from this incredibly happy place where if I give you the robot, you write poetry, go to the beach and spend time with friends. Utopia is possible, but utopia means harnessing market forces in just the right way. Okay. That's political economy. Let me pause here and ask whether you want to pause for questions or personal advice. Okay. This feels like a therapist came to the Capitol. Okay. Look, this now is literally advice as an economist who's engaged deeply in AI, where often what I like to do is talk to people about how you and I, and many of us here are leaders of organizations, can become more effective in the current moment. What's quite striking to me is the enormous variation across people in the intensity with which they're using this tool. And I think there's tremendous gains that are not being realized because our education around this is poor. So maybe I'm your teacher. Look, let me describe what I think of as being the three stages of the AI roller coaster. The first stage is you log into ChatGPT and you're like, wow, this can do my job. And the second stage is you log into ChatGPT and you say, this can do my job. Now, it sounds like they're the same stage, but actually they're different. The first is, this can do my job, and you're so excited because you're going to get time to go to the beach. And then you realize, oh, this can do my job. And now you're worried because you're going to lose your job, right? And what I want to do is, as a mindset, is suggest instead that what I want you to do is think in terms of, if I work together with this tool, this can help me do a better job. Your job is to dance with the robot. It sounds poetic. So let's use some simple economics language. What is AI? Is it a substitute? That is, it will displace workers, it can do what you do. Or is it a complement? Well, which is to say, it's going to supercharge some of us. The answer is, of course, it could be either, it could be both, and it probably depends on who and what you are. But if you want to be successful here, you want to think about ways in which it can become, you could spend all night worrying about how it's a substitute, or you could go out and think hard about how it can be a complement and gain that superpower. And that, again, is just a mindset statement. So here I think, in order to try and think about how it can be a complement for you, I think it's really worth understanding the technology. So what is the opportunity? Well, what we're all used to when we turn on computers is the old model of computing, which is everything we do when we turn on a computer is computer code. Computer code is a set of explicit instructions that convert inputs to outputs. They're explicit instructions, they can be codified, right? That's the important word there. They're useful for codified language. So you can ask a computer, should I stop at the next red light? And it'll say yes, and it's because someone wrote a line of code, if red light, then stop. And that's how the Tesla knows to stop at a red light, right? That's codified language. But what AI does instead is fundamentally different, which is it's basically read millions of examples of everything. And what it can do, or the way it works, is it effectively infers instructions from a whole bunch of examples. It sees a lot of cars stop at red lights. And it's like, you know what? This stopping at a red light looks like a pretty good idea. And so it turns out stopping at red lights is a really simple thing. But a lot of what organizations do, and a lot of what each of us does in our lives, is really tacit knowledge. Something where we weren't actually taught it, we just learned it by osmosis. AI basically learns by osmosis. So tacit knowledge has always been something that those of us who are old cared a lot about, because that's the stuff of wisdom, and that's what makes us so much more productive than young people. But AI can learn this, so the wisdom of age just went away. Because basically it can infer, effectively the way we learn tacit knowledge is by observation. And that's what the AI is doing. Okay. So therefore the new opportunities are all about how can we exploit, learn, redesign the use of tacit knowledge in the economy. So a question that I often get is, well, my kids are about to enter this new economy, what should I tell them to do differently? As a professor, this is one that very much weighs on my mind. I need to educate people. How should we educate differently? Where should we invest in skills? What is the future? So I think I've already said a few things that are kind of really important. One is, if you can become a professional athlete, do, because that is not going to be AI'd away. The other is, do not become a translator, right? That job now is perfectly done by ChatGPT. And the question is, between those two extremes, where do we live? And this is where this tacit versus codified knowledge thing becomes quite important, because you can think about programming and writing skills, they're effectively codified knowledge, right? Coding literally is codified. There's a language with a formal structure, it's written down. If you deviate at all from a programming language, nothing works. It's literally codified language, right? And if you own Strunk and White, you realize that writing is also basically codified. You can program up a computer on the corpus of Strunk and White. So programming and writing skills all of a sudden have become basically worthless. Not worthless, intensely valuable, but a low price. Low price because AI can do it for us. So what's left, if it's not physical labor up one end, and so, if you want to tell your kids to go into physical labor, you can, but historically that's not been where wages are highest. So what lies in between is basically science and critical thinking skills. And so I think this is a half-formed thought. It's not particularly well argued or well articulated here, but this looks like where one should be thinking about investing if one were thinking about, education and the future of education. So that's where my advice is. And then again, I think a lot of the issues here about the adoption or failure of adoption of AI in workplaces, including those here, are mostly about mindset. And many of us, the first time we turn on a computer and understand it's smarter than us, feel small. We feel lost. We had an identity. I was the smart guy, and now all of a sudden I learn a computer can do everything I could do. Again, I feel like a Detroit auto worker in the 1970s if I could be replaced by a robot. So at a very human level, what we tend to do is we go searching for the shortcomings of AI. And I can't tell you the number of colleagues I've talked with who've said to me, I don't use AI very much. I tried it and it didn't work. Well, you know what? If you try anything for 18 seconds, you'll be terrible at it. When you're terrible at something, you get terrible results. Essentially what they're doing is they're looking for the shortcomings of this so that they can maintain their identity. Wrong mindset. And my students have a completely different mindset. My students are saying, what can it do? Instead of what can't it do. And what can it do is a completely different mindset. And the thing is, as much as my colleagues can sometimes come up with shortcomings, they'll tell me that AI hallucinates. It can, if you use it badly, but it turns out there's a single parameter deep inside the system called temperature, which if you turn it to 0, you can essentially eliminate hallucination. So that's not an excuse not to use it. It'll say, my colleagues have said things to me like it writes terribly or its responses are formulaic. If you have it write something for you and it's in that bland corporate speak, what you do then is you say, please rewrite this like Hemingway. Then it'll be amazing. People say that it makes simple math errors, and the early versions did, but it also has a way of calling up, creating computer programs, and therefore it won't make math errors. So a famous example is if you ask AI which number is bigger, 3.9 or 3.11. It says 3.11 is bigger. The reason for that is software version 3.11 comes after software version 3.9. And so it's used to 3.11 being a bigger number than 3.9. It thinks in words, not in numbers. But it's also an easy problem to solve. If I actually wanted to know which number was bigger out of those two, I'd say, could you write a computer program that evaluates which of these numbers is bigger? And it does that, and it always gets it right. People say that AI lacks creativity. People lack creativity too. And actually, if you think about it, I'm not sure. So there are actually many studies that show tremendous, what we would call creativity. And if you think about it, it sort of makes sense, because what is creativity? Creativity is very rarely thinking about a new idea from scratch. It's actually the combination of existing things. Let's think about creativity with cooking, which sounds profoundly human, right? And that's all about knowing which ingredient goes with which. It's knowing that apple goes with cinnamon. Well, the thing about AI has read all of the world's recipe books. It knows that apple goes with cinnamon, and it also knows that in Afghanistan they believe that apple goes with this other herb. And so it could come up with a new recipe which combines the best of Afghan cooking with the best of American cooking. A lot of creativity is recombination of existing ingredients, and AI is remarkably good at that. And then the final one people sometimes say is computers lack empathy. So do people. And the big difference, by the way, is that computers never get tired, but sometimes my students email me in the middle of the night, and I do. And actually, there's very good studies where they gave, people wrote in with their current medical complaints, and half the people's complaints were given to doctors and the other half were given to AI. AI was more accurate. It's actually not much of a surprise. But AI responses were more empathetic as well. People preferred the responses they got back from the AI. And again, I think the reasoning's obvious, which is the computer just keeps going. The computer never gets tired. The computer never gets pissed off. People do. So, you know, all of that's to say, don't think of it as, and let me add one final thing to what I'm saying here. Remember this, the worst AI you'll ever use in your career is the one you used yesterday. So even if it fails at some of these margins yesterday, it won't tomorrow. Okay, now I'm going to get really personal. It feels totally goofy to be in this grand room giving you personal advice like this, but I'm going to give it anyway. The advice is, this is a challenge, and it's a challenge for each of you. Wake up every day and open a tab with your favorite large language model. I don't care which one it is. And what I want you to do every day is think of one new task that you would otherwise do yourself and just give it to the large language model. And that's how you're going to figure out what it's good at and what it's bad at. And most people have an intuition it'll be bad at most tasks. And what you end up learning when you do this is almost every day you give it a new task, and almost every day you learn, oh my goodness, it can do that too. And so I learned this the hard way. One of my friends, I organized a family vacation to Tasmania, and one of my friends said, did you ask AI to organize your trip for you? Like your itinerary, like which sites do you want to go to, what order should you go in, and so on. And I was like, no. And he's like, you realize that it's read literally tens of thousands of travel reviews of people who've been to Tasmania. You realize that it knows which hotels are near which cities and which sites are near. And it actually turns out it's amazing at that task, something I would never have asked it to do. And so my challenge to each of you in the room here is, you know, tomorrow it might be edit the next email you send. It might be that you need to design a new logo. It might be you need to plan your vacation. It might be you see interesting data in one of Gabe's charts, but you want to extract the underlying data and you say, could you do that for me? It might be you want to learn a new language. It might be you want to brainstorm new product ideas. It might be you want it to write code. I will neither confirm nor deny it. Sometimes helps my social media posts. Likewise, sometimes my kids want a bedtime story, but I'm tired. And it turns out it's amazing at that too. And then if you want to take this challenge one step further, Claude Code is this new approach, which is basically it will write a computer program for you as if you had a coder in front of you. So you say, I would love a computer program that will read in all my receipts and send them to my assistant for reimbursement. And you'll type a few sentences like that. It will design the program exactly for you. So you now, whether you know it or not, are also a computer coder. So that's my personal advice to each of us in the room. My guess is if you do one new task each day, that in 30 days' time you're going to feel a whole lot more empowered on ways to use the tool and have a much better understanding of how far we can push this tool than most other people in the economy. So we've done microeconomics, macroeconomics, political economy, and I'm going to call that therapy session me-conomics because it's all about you. Let me stop there.
Except for I appreciate that presentation a lot, and I also appreciate the green in there.
Wow. Wow.
Yeah, you brought the blue in, so I got to bring the green in. So I don't know exactly how long you've been actually looking at AI, but sort of real quick, you know, in a 5-year period that you've started looking at to where you are now, how much like sort of growth have you seen in some of these industries? I mean, I assume some are more quickly apt to pick up an AI and use it than others, and then then you just have people like us, right, push back, like, oh, I don't want to use that,
Right.
So,
I showed that little pie chart that said, like 10% of companies are using it. Look, the answer is adoption's remarkably slow. There's two possible reasons for that. So one, if you want to be a grump, you say, all the pro-AI guys are wrong, this is useless, it doesn't do anything. I just think that's wrong. But that's an argument. The counter-argument is my observation, which is the barriers are predominantly psychological and sociological. That I was reading recently. So think about the work of a lawyer. Read vast corpuses of text, summarize it, and show its relevance to a particular issue. AI is really good at that. And it doesn't get tired, and it doesn't charge you $1,000 an hour, right? Law firms basically should, and in my guess, will completely hollow out. And so there'll be partners, and there'll be computers below them, right? Very few law firms have transformed. And law is the most obvious possible application of this. And I do think, and I'll tell you, like talking to other academics has been genuinely depressing. They really do turn the computer on and they try and look for the things it does badly. And when you want someone to fail at something, you do a great job at it. So, I think the rollout's been really quite slow. Now, the thing is, capitalism is this crazy beast, which is all of the incumbents could be sitting in our offices saying, it can't help me, it can't help me. And some 22-year-old in California is going to start the world's cheapest law firm, which is going to draft your next contract at $1 per contract, and a bunch of business will go. So maybe it's not going to be our existing businesses will either have to wake up, or perhaps the 22-year-olds are going to come and eat them all. Or this is just like past revolutions. It could be the thing that held us back in these past technological revolutions was also this psychological, sociological, which union is going to be excited about AI adoption in the workplace? Which professor is going to say, you know what, the computer's better than me, why doesn't it teach this afternoon? And I think that's the fundamental barrier. So when you ask where's it had a big effect, the biggest one actually is in the creation of AI. I mentioned it briefly, Anthropic, which is one of the big 3 companies, all of its code to create AI is written by AI. Anthropic's coders don't code. They tell AI to code for them. And I will tell you, like, I've been coding the last couple of days, it's the most amazing thing you've ever done, which is you just speak out loud and all of a sudden 3 weeks of a coder's time is gone. Now, the thing is, maybe that's the right answer to your question. That's the industry that's fundamentally changing, which is those guys are very cost conscious. They're not all unionized. They're very, right to the bottom line. And also coders love code. So the idea that code will code instead of coders, you're not hearing coders do what professors do, which is, it could never be as good as me. Maybe their egos are a little different.
Thank you so much for the presentation. I'm thinking like in your green box macroeconomics, just about uptake and if there is this exponential opportunity in GDP growth and you have larger corporations where it's easier for them to adopt and take advantage of that versus smaller companies. My parents have a heating and cooling company and we're trying right now to get like the techs in the field to take a picture of their handwritten notes and email them back to the office to make things more efficient. So like the uptake for companies like that will obviously be much slower. And so what does that mean for like the broader mix? if you think about like small business, GDP contribution, larger corporation, are there any projections along those lines?
Right. So it's a great question because it reminds me to say something I've said 3 times, but I should have said 15, which is there's tremendous uncertainty about everything. No one knows anything, right? The projections I showed you were sort of people making stuff up and hoping, and they're trying to get the number of zeros correct. And so far, we believe the number of zeros is either 0, 1, 2, or 3. So we're not doing great. Let me use that humility as a way of answering your question. I don't think it's by any means obvious that adoption will be easier for big tech, for big companies. Big companies have org charts and they've got fossilized people sitting around and, you know, have you ever tried to turn the Titanic around? So it doesn't seem at all obvious to me, but it is one of the reasons I use the word mindset. I think your parents, if they took my 1 task a day challenge, will be like, oh, and I'm telling you this because my mother runs a company and we just celebrated her 80th birthday. And she is a true believer. She's like, wow, this can just do things. She runs an education company. One possibility is yours, which is this turbocharges big companies and we become an even more hierarchical society. Maybe you even worry about these companies having undue political influence. That doesn't seem like something that would happen in the United States, does it? The other possibility is actually that it turbocharges small and nimble. And one of the things to realize is starting an auto plant requires, you got a couple of billion sitting in your back pocket. Starting a company that provides AI services to heating and cooling companies, you and I could do it by this afternoon. So there's not big barriers to entry here, and it's partly the modular nature of all of this. Remember, I described this as sort of Lego software. It is fairly easy to just get moving by the end of the afternoon.
So, yeah. Professor, how far are we away from Skynet launching, in your opinion, based on your data?
I have no idea what a Skynet is.
Oh, wow. And I thought I was the youngest one here, but I need to take that cake. No, but in all seriousness, in Michigan, I look at the way AI could...
Oh, that was a popular culture joke.
Yes.
Wow.
Terminator. Come on, the audience, tough crowd here.
Did I just show that I'm an academic or what? There's this hip new band I've heard of called the Beatles. Sorry.
In the data you presented, I'm specifically thinking about 2 industries here in Michigan that kind of lead the way for us, right? Our manufacturing side and healthcare services, right? Those are the 2 big spaces that help power Michigan's economy. How specifically do you see the integration of AI, maybe even in healthcare? I'm seeing now AI bots that are take a picture of this and we can diagnose it, things like that, impacting those industries in Michigan.
Right. Let me just start by acknowledging that is a question from an extraordinarily well-trained legislator who knows a lot of economics.
I had a very good economics professor.
Yeah. So I should have answered healthcare as one of the other industries that I think is actually starting to move pretty quickly. So, last time I went to the doctor, the computer was listening in the background and it took all the notes instead of him scribbling some nonsense that would never either get typed up or would never get integrated into the file. And also there were no mistakes made except for those words that sound different in Australian. So it's a huge part of the economy and there's a lot going on there. We're quite some distance from people being willing to trust an AI doctor. It's actually crazy because the AI doctor's more accurate. It's a little bit like how we feel about driverless cars. Every time one gets in an accident, it makes the news. Every time a driver car gets in an accident, it doesn't make the news because we expect drivers to kill drivers. To the questions that you ask, they're good questions. Let me try a little bit, just adding some structure here. So this is a white-collar revolution, not a blue-collar revolution. So that puts healthcare right in the heart of it. And there's a hard question with modern manufacturing whether you want to think about that as blue collar anymore. When you walk into a plant and it's a bunch of robots doing stuff, and basically people making sure the robots don't malfunction, that doesn't feel very blue collar anymore. Those are probably both industries where there's going to be tremendous change. I'm a manufacturing pessimist anyway, which is to say, to the extent that manufacturing relies on unskilled labour, there's the rest of the world. To the extent that it relies on skilled labour, that's where we ought to be thinking. And skilled labour augmented by AI would be amazing. I think there's a bunch of inequalities that are worth thinking about. So one is, do the returns go to capital versus labour? And as I tried to point out, that depends a lot on exactly how we regulate this. At the moment, the world is set up so that the businesses get all the rents rather than the people, but we could imagine them going to people. It's going to make white-collar labour cheap relative to blue-collar labour. And so if your caricature of Michigan's labour force was at its blue-collar, we had our technological revolution in the 70s. It crushed the blue-collar workers. It's the white-collar guys' turn now. And then within a workforce, remember, so far, and this is only a so far statement, AI has done a better job at helping the less talented workers and doesn't do as well with the more talented workers. So that would suggest it's going to be a force for equality within any given workforce. So I think adding all those up actually becomes quite difficult. A lot of people think this is necessarily going to be a force for inequality. That's because they're thinking about OpenAI becoming infinitely rich. But blue-collar workers catching up on white-collar workers strikes me as a really important change. As a white-collar worker, it probably means my future income's lower, but for equality across the population, it's fantastic news.
All right, thank you so much.
Thank you.
It was a pleasure, thank you. We would like to now bring up returning to the Senate, House, and Administration Economic Outlooks and Revenue Estimates. This will be staff from Senate Fiscal Agency, House Fiscal Agency, and Department of Treasury. So David Zinn from the Senate Fiscal Agency, Ben Gielczyk from House Fiscal, and Eric Bussis from Treasury. Thank you.
Yeah. We'll let that chair do the post.
Right. Good morning. It's a pleasure to be here. As Chair mentioned, I'm Eric Bussis with Treasury, and I get the opportunity to set the stage for our presentation today. So I'll be talking a little bit about the economic and revenue updates. We're going to talk about what's changed since the last time we had a revenue conference in May. I'll then turn it over to Ben to talk about our forecast of major taxes, and then David will close us out with an estimate of fund and some statutorily required estimates. So just, you've heard a lot of economic presentations this morning. So, we also, as a part of this conference, bring economic forecasts to the table. And we're not going to spend a lot of time on this because it very much aligns with what you've heard from RSQE. But a couple highlights: we're all forecasting continued modest economic growth. We do expect that inflation will continue to remain a challenge. And slightly higher than the Federal Reserve's target rate of 2%. Employment, we do see that slowing, but still remaining positive. In terms of the Michigan economy, we expect the Michigan economy to track national growth. We expect personal income to continue to grow in Michigan, but albeit a little bit slower than the U.S. rate in all of our forecasts. Employment growth follows a similar trajectory with continued growth, but slightly slower than the U.S. rates. We're going to start with a comparison of the Michigan economy since the May crack in terms of actuals and how calendar year 2025 ended. Personal income ended up being a little bit higher than we forecasted in 2025, growth of about 4.2% instead of the 3.6% that we're forecasting, or that we forecasted in May. In terms of payroll growth, we forecasted in May about a 0.5% increase in total employment. In the preliminary numbers, right now, that's about 0.8% growth. Although, as Gabe mentioned, we are expecting some benchmark revisions. Too early to tell exactly how those will end up, although the early indications are that those will be negative, and we expect that to push the actual job growth closer to the May consensus. But overall, our economics are very much in line with what we forecasted at the last revenue conference. In terms of revenue collections, since we last met, collections in fiscal '25 are not final yet. Book closing is still in process, and in the preliminary numbers that we have, we do track that tax revenue is tracking a little bit below our May consensus. So the 5 taxes you have here, so income tax withholding, sales and use, which is combined on one line, and then corporate income tax and state education tax, those are about 87% of our total general fund and school aid revenues. So we've got a lot of other taxes that we forecast, but this is certainly the largest drivers of state tax revenue. Combined in these tax revenue categories, we're tracking about $328 million below the May consensus for fiscal '25. The biggest driver of that is a shortfall in corporate income tax, which we'll talk a little bit more about in the upcoming slides. But I wanted to highlight income tax withholding continues to be a strong driver of growth. We did miss the target that we forecasted in May by about $50 million, but overall we still had 5.5% growth. That's very strong growth in terms of wages and earnings by Michigan residents. Turning now to the next slide. In terms of sales and use tax, this is again one of our more impactful taxes, and a tax that's been important over the last 5 or 6 years in terms of explaining the growth of state revenue. We saw tremendous growth, as everybody knows, who's attended these conferences coming out of the pandemic. Just for context, we had growth from 2020 to 2022 of about $3.2 billion on an annual basis. And since then, from 2022 to 2025, we've seen growth really fall off. So over that time period combined, we saw an increase of about $180 million over those 3 years. So in terms of percentage changes, we're now tracking for the 3rd consecutive year, year-over-year increases in sales and use tax that aren't keeping up with inflation. So we're seeing real inflation-adjusted terms. This tax is declining year over year, and that's certainly something that has changed the trajectory of our forecasts over the last couple of years in this returning to more normal and pre-COVID growth rates. The next tax we're going to talk about to set the stage for the later presentations relates to the corporate income tax. Corporate income tax continues to be one of our most volatile taxes. I'll point out the axis here. There's not many charts we're going to show you that range from having increases of over 50% and decreases of about 15%. If you look at this, it kind of follows the path of a ping pong ball if it was bouncing between positive and negative growth. Since we've implemented the tax in 2012, we've seen continued volatility. Aside from the first couple of years where we had positive growth as the tax started and, ramped up. Just looking at the last 10 years, we've had 5 years where we've had year-over-year increases and 5 years where we had year-over-year decreases. Of those changes, 7 of the 10 years had double-digit growth, whether that was a double-digit increase or a double-digit percentage decrease. And we saw that again in 2025. We had the largest decrease on record in the preliminary numbers at about 14.9%, and it was the biggest miss among our major taxes. And the next slide illustrates a little bit of the reasons behind that. So 81% of our corporate income tax is collected through estimated payments, and we had very weak collections in September and October of 2025. This corresponds to the third quarter of the tax year 2025. So this is the third quarterly payment for most taxpayers. We were down year over year by about 165 million. I think there are a number of reasons for why that likely was. We see inflation and slower consumer spending squeezing profit margins of businesses and putting downward pressure on corporate profits. Additionally, tariffs are impacting some businesses, including manufacturers that may have set prices that they have to deliver their end products, and their costs are continuing to increase. The third and probably most important measure or impact was just the timing differences between the implementation of the One Beautiful Bill Act and some of the corporate tax changes that happened there, and then Michigan decoupling from some of those business provisions. The good news is this is outside of the scope of fiscal '25, but in December of 2025, we saw our largest quarterly payment month in recorded history of having the tax, and saw a pretty large increase over the past couple years. This was the highest month by about $40 million. So that's not gonna help '25 revenues, but moving forward into '26 and '27, we think that sets the stage for a more normal return in CIT growth. And so we're hoping that the bounce in '26 is more positive. So that's the last slide I have on fiscal '25 revenues. I do want to mention, we showed, especially on slide 3, slide 5. I meant to mention here, these are, although huge parts of our tax base and our tax forecast, and this shows that we were down in fiscal '25. There are other factors here that are still driving growth higher. We had very strong non-tax collections. So in total, we actually ended up pretty close to the May consensus, although these 5 taxes did drive us below target. So I wanted to go back and mention that, because that's another key point as we look forward to the upcoming forecast from Ben and David. So the last slide I have is on slide 9. And this really sets the stage for the rest of our discussions around revenue. This is the first consensus conference that we've had since there have been a number of tax policy changes and revenue shifts. So I wanted to make sure to frame this discussion. So first of all, the discussion here today is forecasting just general fund and school aid fund revenue. So to the extent that the state made a change that either increases or decreases other funds or tax revenue directed to the Michigan Transportation Fund or the New Neighborhood Roads Fund, that shows up as a negative here in this forecast, but it's not, certainly not things or revenue that's just disappearing. So I know that looks like there's a negative here, but that's just due to the nature of how we view things and our statutory framework for the consensus conference. So when we look at changes to our policy baseline, going back to the last revenue conference, there are a number of things. I would note that a lot of these changes resulted as the enactment, or with the enactment and passage of the last state budget and the road funding package. There's a lot of things that are noted here and a lot of things that aren't noted here in terms of decisions that were made during that time related to conforming to the One Beautiful Bill Act and decoupling from that. So I know one question we've gotten from stakeholders is, well, where does the decoupling from the One Beautiful Bill Act and some of those provisions show up in the consensus conference here? And they will not appear because they were unknown at the time of the May consensus, and anything that we've decoupled from just avoided having a line here as opposed to having a positive. So in general, though, we see revenue impacts that we're building in here of about $800 million in fiscal '26 and $1.1 billion in fiscal '27. I'd note that, although they're being reflected here for the first time, they're certainly not surprises to policymakers. These numbers showed up in fiscal notes put out by the Senate and House fiscal agencies and in analysis that Treasury did as a part of the enactment of that budget. But there's a number of changes, including dedicating money to other road funds that are not a part of the consensus conference, as well as conforming to the tax on tax deduction for tips and overtime and the changes to the Tier 3 Social Security taxation. So with that, I'll turn it over to Ben for tax forecast.
Thank you, Eric. So the next series of slides will present a forecast of major taxes that go into the fund balances that David will talk about in the last section. Each of these taxes will be presented with both a preliminary estimate of fiscal year '25 along with the spectrum of agency forecasts across fiscal years '26, '27, and '28. I'll note that everything but the corporate income tax is presented as a net revenue estimate, meaning they incorporate those tax policy changes Eric just spoke about. In short, net revenue is basically the amount of revenue we estimate to be available for appropriation. So turning to this slide, you can see individual income tax withholding estimates on a net basis. Withholding is the largest component of the income tax and probably the least volatile with respect to annual growth rate changes. It is mostly driven by employers withholding on employee wages, but there is a piece that also comes from distributions from 401ks or other retirement and investment accounts. You can see the preliminary final estimate for '25. Eric noted this, but I also note that while it was 0.4% below our May '25 estimate, it still represented fairly strong growth at 5.5%. All three agencies do forecast continued growth, but at a slower rate. However, after Dr. Wolfer's presentation, I'm thinking maybe we should go back to the drawing board for some downward revisions. In fact, this may be one of the last times that we present this forecast to you, I guess. I saw the AI gleam in Marianne's eye. In all seriousness, for fiscal year '26, growth rates range from 1.1% for Senate fiscal agency to about 3.3% for the administration, which is on par with our economic forecast for each agency. The agency growth rates converge a bit in fiscal year '27, with SFA forecasting 2.5% growth at the low end and HFA forecasting growth of about 3%. Once you get out to fiscal year '28, the script sort of flips a bit with the administration forecasting 2.3% growth on the low end and SFA on the high end with 3% growth. The next slide shows net income tax refunds. The preliminary '25 estimate of around $4 billion was about $400 million more negative than we had forecast in May. I think here it's important to note that refunds are paid out of the general fund, whereas the other incoming individual income tax components, withholding, quarterlies, annuals, are split between general fund and school aid fund. And that will sort of show up and explain some of the changes we had from May and differences in agency forecasts that David will discuss in the next section. Looking out at the agency forecast, you can certainly see some divergence between the agencies and consistency in that divergence across all three fiscal years. HFA is consistently on the high end of the estimates for refunds, and the administration is consistently the lowest throughout the forecast window. Refunds have shown some volatility historically, and especially so in recent years, and I think that plays a bit of a part in the distribution of forecasts in this slide. Next, we will look at net individual income tax, meaning withholding and refunds, which I just spoke about in the prior two slides, but also quarterlies or estimated payments and annual payments. Net income tax revenue is a significant part of the state fiscal picture. After removing the $600 million earmark to the Michigan Transportation Fund under the recently passed roads package, net income tax represents about 40% of combined general fund and school aid fund revenue. On a fund-specific basis, it represents almost 2/3 of general fund and about 1/4 of school aid fund revenue. Looking at the forecast, all agencies project year-over-year growth in net income tax through fiscal year 28, but the growth projected by each agency varies mainly due to the information presented in the prior two slides with withholding and refunds. If you look at fiscal year 26, you can see that the administration projects the strongest growth in net income tax at 3.6%, which makes sense, certainly considering that they had the strongest withholding growth and the lowest estimate on individual tax refunds. The administration projects about $310 million more in net income tax revenue than HFA, which is at the low end there in fiscal year 26. The gap between the administration and the lowest estimate increases to about $340 million by fiscal year 28, with SFA's lower growth projections resulting in the lowest estimate for net income tax in fiscal years 27 and 28. On a net basis, all of these represent estimates below May, albeit a modest reduction in the case of the administration. The next slide illustrates our forecast for sales and use tax revenue. For context, sales tax is about 3.5 to 4 times the size of the use tax as a revenue source. Combined sales and use tax makes up about 30% of GF and SAF revenue and just less than half of school aid fund revenue. One important note on this graph, you'll notice there's a drop in net sales and use tax revenue from fiscal year 25 to fiscal year 26, and that sort of resets the growth path there in the out years. That is due to reasons Eric spoke about, but mainly the sales tax exemption on motor fuel enacted as part of the roads plan last year. This basically levels down the net number because we estimate we will be collecting about $800 to $900 million less on a full fiscal year basis. That said, as Eric has noted on an earlier slide, sales and use tax growth has been fairly tepid over the past few years, even on a baseline basis. Generally, we expect that to continue over the forecast horizon. I would just restate what was said also on an earlier slide. On an inflation-adjusted basis, the growth rates on combined sales and use tax for all agencies are negative. Said another way, meaning just our inflation estimates across all 3 years exceed the growth rates projected in these combined taxes. The next tax we'll discuss is the corporate income tax. This has been fairly volatile tax over its history, as we discussed, making it a somewhat difficult tax to forecast year to year. I will note that these figures all add back the restricted fund earmarks related to Healthy Michigan, RAP, and housing in fiscal year 25, and then the Neighborhood Roads Fund and housing beginning in fiscal year 26. Eric discussed this in an earlier slide, so I'm not going to go into detail again, but CIT collections for fiscal year 25 were well below our forecast in May, coming in about $340 million lower than forecasted. I will note that the differences in fiscal year 26 somewhat reflect different assumptions around fiscal year 25 OBBBA and state decoupling effects and how that might be addressed in fiscal year 26. Generally speaking, we all forecast growth on differing levels across the forecast on a baseline basis, with annual totals in the $2 to $2.2 billion range, which is in line with CIT revenue levels after fiscal year 20 to 22. The last of the major taxes we'll discuss is the state education tax, or SET. The SET is all directed to the school aid fund. It represents about 15% of overall SAF revenue. This tax is largely driven by growth in property tax assessments, which are capped at the rate of inflation, or 5%, whichever is lower, and housing market conditions. For these reasons, it is also a relatively stable tax. As you can see, there's not a lot of variation among the agency forecasts, and we all project growth over the forecast horizon. These would all represent historic nominal highs for set revenue, going from about $3 billion in fiscal year 26 to about $3.2 billion in fiscal year 28. Lastly, this slide provides a look at the range of our forecasts on various revenue sources. We touched upon a few of these in the previous slides, but really this set of revenues and the differences exhibited here account for most of the differences in total revenues by fund that David's going to discuss in the next section. I think one thing to note here is that for each of these revenues, the differences in the high and the low can represent different agencies and do represent different agencies in these various revenue sources. As you can see, for most of the revenues represented, the gap remains relatively similar on a dollar basis between fiscal years 26 and 27. The largest dollar range is in refunds, and that also represents the largest percentage-based gap over 2 years for tax revenues, representing a gap of a little over 8% in both years. As noted on the refund slide seen previously, the administration was lowest on refunds, meaning less negative, and the HFA was the highest. I will say the range on non-tax sources, the bars on the far right, is bigger on a percentage of non-tax revenue basis, but those revenues aren't necessarily driven by economic conditions and have been quite volatile in recent years. In this case, it involves differences in estimates for common cash, interest earnings, and escheats revenue. The administration was on the high end, and HFA and SFA were similarly situated on the low end. Withholding has a slightly smaller dollar gap than refunds, but represents only about a 2% differential on about a $14 billion base. Here, the administration was the highest, and SFA was the lowest. Rounding out the other revenues shown here, the sales and use tax range was less than 0.5% in both fiscal years. The administration was on the high end and SFA was on the low end. For income tax quarterlies and annuals, the difference was about 1.5% in both fiscal years. Here, SFA represented the high mark in fiscal year 26, while HFA represented the high mark in 27, with the administration on the low end in both of those fiscal years. And then lastly, for CIT, the gap in fiscal year 26 was about 10%, with HFA on the high end and SFA on the low end, mainly due to differences I mentioned around the treatment of the fiscal year 25 OBBBA and decoupling issues. That gap closes to just under 7% in fiscal year 27, with the administration on the high end and SFA on the low end. I would just say a common theme in this chart is that the revenue streams that we've discussed that have been the most volatile historically are generally seeing the largest forecast range on a percentage basis. Think CIT, refunds, and non-tax revenues like common cash, interest, and escheats. So that's just something to note about those ranges presented. And with that, I will turn it over to David, who will put it all together by fund.
Thank you very much, Ben. We'll start off with talking about baseline revenue, which, as you recall, omits the policy changes, particularly stuff that's been enacted since the May CREC, but generally we use prior year law and then work forward. It allows us to separate generally economics from policy changes so that you can see what's going on there. The preliminary revenue for combined general fund and school aid fund for FY25, you can see, is just over $36 billion. We are all expecting growth in future years. For 26, the growth rates range from 1.2% for SFA to 3.4% for Treasury. After that, we all kind of settle down to about 2% growth in the out years. Generally, these growth rates are below any of our forecasted inflation rates. So combined revenue would essentially be declining on an inflation adjusted, or the buying power for the state, so to speak, terms. In terms of the differences, while the differences here are about $800 million per year in terms of the spread, like Ben was talking about, that's about 2% of revenue. So while for budget purposes it's a lot of money, estimation error, it's not a particularly large divergence. One thing I would mention in terms of those growth rates of about 2%, if you look at what the growth would be like during the 2011 to 2019 period, we averaged about 4% per year. So we're talking about half the growth essentially over the forecast period. If you looked at the growth between 2001 and 2010, because of two back-to-back recessions, essentially, we actually averaged a decline of 0.6% over that period. So we're doing better than one decade, but not as well as another decade. If we look at just the general fund purpose, general purpose aspect, this is going to be a little bit more volatile because the components that go into it, like CIT and income tax refunds, show where we have the most variation in terms of our estimates. The administration, as Ben pointed out, has stronger growth in most years. In 26, the growth rates range from 0.2% from SFA to 4.4% with the administration. But in out years, we all converge to about that 2% growth sort of thing. Not all of this is economics. A lot of it is assumptions about the non-tax revenue. There's kind of an element where we all kind of know where we're going to get at some point, and our time path, particularly on the non-tax revenues, differs, as well as kind of some short-term uncertainty about volatility on the volatile sources. And so you'll see that going forward, where we kind of look closer in out years and more apart in the near-term years, whereas usually it's the other way around. The deviation here ends up being about 4% of revenue, except in FY28, where we're down to about 3%. Once you put those tax policy changes in, you can see it drops the revenue levels quite a bit. Only the administration shows a gain in FY26, and that's really not much of one. It's a 0.3% increase. The House and the Senate both show decreases in FY26. All three agencies forecast a decline in FY27. And we all have growth in the 3 to 4% range in FY28, largely because of Michigan business tax credits dropping substantially. We pay out about $500 million a year now, and that'll drop to about $300 million in FY28. And so that accounts for a lot of the growth that we end up seeing in FY28. The deviations here end up being, in terms of our variance between the high and low estimates, end up being about 5% of revenue, except in FY28, where we are closer and it's more like 4%. For school aid fund, it follows more like the total, largely because the school aid fund's held harmless for most of the policy changes, and it is a larger share of the combined total, and so it's going to dominate the pattern. We have steady growth in all years. The range in FY26 is between 2.1 and 2.7%. And then once again, we move down to kind of that 2% growth in the out years. The spreads here are about 1%, so we are much closer, except in FY26, where we do have that normal pattern of where we're closer together in the short-term years, where the deviation between the high and the low accounts for about 0.6% of the estimates. On a net basis, as all of us have mentioned, the school aid fund's been held harmless for the policy changes. So as a result, net revenue looks more like baseline. Our growth rates are even closer. The spread is a whopping 0.8%, declining to 0.5%. Except in FY26, where it's 0.5%. Combined, we're all adding roughly the same amount of money over the forecast here between general fund and school aid fund that you saw in Gabe's forecast. We're just moving it from different levels off of 26. But over the whole course of the forecast, we get about the same amount of money. This just gives you dollars rather than looking at bar graphs or in a wave to Ben's predecessor, Jim Stansel. If you want more significant digits than we display in the graphs, we've got them here, but this is the detail here. In terms of our differences from the MACREC, this shows it broken out by agency and by fund. The bars make the deviations look quite a bit larger. That's that issue of it's $800 million for you all on a budget basis, but as Ben pointed out, on a percentage basis, these are not particularly large revisions to the revenue. You can see that all of us are raising our estimates for school aid fund revenue, and we all have declines relative to May in general fund. The declines largely represent the different assumptions on some of the stuff like corporate income tax and non-tax revenues. This breaks that out in terms of what's the economics versus the policy changes. So you see under the tax policy, we've all got the same number. It's about an $800 million ding in FY26 and a $1.1 billion ding in FY27. But you can see then that $800 million spread driven by our economics and our assumptions about non-tax revenue. So this is basically decomposing the economics from the policy for what you saw in the previous graph. In terms of the Budget Stabilization Fund, there's a formula that recommends whether or not we can take withdrawals or must make deposits. Regardless of whether it's recommended, the legislature actually has to enact said withdrawals or pay-ins. We don't calculate that there would be any recommended pay-in over the course of the forecast. As we did in May, a withdrawal is recommended for FY26 of up to $538.7 million. None of the agencies calculate a recommended withdrawal in 27 and 28. The state also faces a constitutional revenue limit on how much revenue from all sources, not just general fund and school aid fund, can be collected. It's 9.49% of basically a lagged measure of personal income. I would point out that most of the policy changes that we've talked about before, while they affect general fund revenue primarily, because it's fund shifts, they're moving it to other funds that aren't general fund and school aid fund and don't really impact what's going on here in terms of the revenue limit, because they're still state revenues. Probably the only noteworthy policy change that would affect the state revenue limit that isn't in ours was the wholesale marijuana tax, which would add to transportation revenue and the state revenue, but you don't see it on our general fund or school aid fund numbers. Having said that, revenue is anticipated to grow slower than inflation. So any real income growth, and you saw that with Gabe, there's some increases in real income, will end up increasing the amount by which we fall below the revenue limit. The forecast is that in FY25 we were 19.5% below the revenue limit, and that will increase to almost 23% by FY28. In terms of forecast risks, we've got a few. One was mentioned a little bit in Gabe's forecast in terms of labor markets, in terms of labor market participation, in terms of migration, both domestic and international, in terms of retirees leaving the labor market or not leaving the labor market as they get older, and there's a lot of uncertainty of how that can play out. Similarly, Gabe and Daniil highlighted the issues of the USMCA agreement and its renegotiation. It's kind of an unknown. All of us have built in that things will continue largely something similar to what we've got now, but it can be a source of uncertainty. In terms of non-tax sources, they've become a larger and more volatile component of GFGP revenue. Prior to 2022, they made about 3 to 4% of GFGP revenue. In FY23, they were 8.6% of revenue, and even in FY25, we're still at 7.3%. So it's a much bigger component, and we find out about a lot of these after the end of the fiscal year, when we find out how much is getting transferred from the liquor purchase revolving fund, or how much we made off of interest because of balances in terms of cash flow and stuff like that. And so how that plays out as we move forward with the budget situation we have will make things more volatile in terms of the accuracy of our estimates. And finally, things like the transformational brownfields, these capture revenues, most of the impacts are outside of our forecast horizon, but it's still a little bit unknown exactly how it's going to get accounted for. The totals, as you can see here, awards and in process already total $1.8 billion. So there's kind of a lot of uncertainty of that. Fortunately, as the point is it's mostly outside of the forecast range here, but we want to keep reminding you that at some point, it'll be in the forecast range. So, and with that, we're open to any questions.
Thank you for allowing me to ask a question. I'm Representative Julie Brixie. So the last slide that you had talking about the revenue forecast risks, I think this is always something that is makes you nervous at times, and you're always happy when you guess under, not over. So I was wondering what you gentlemen think the danger to the economy and some of these revenue impacts is of the, at the federal level, of the presidential interferences of the Fed chair and threats of manipulating the interest rates. What kind of risk do you think that that provides to us?
Generally, we've all built assumptions into our forecasts of about what we think fiscal and monetary policy will be. I can't say that they differ that substantially from what RSQE has in. Obviously, any type of uncertainty does kind of have some level of an economic impact. That's why we have the USMCA on there, given our reliance, being on the border, having a lot of trade with the auto industry, with Canada. Then renegotiation of that really holds the potential to not cause problems or could cause problems, regardless of where it goes. If it looks like it changes, even if it's to our benefit, or not to our benefit, it creates uncertainty, and so businesses sit in a holding pattern there. In this case, with that particular risk, we're assuming we're not going to get a holding pattern sort of thing. But I think, you know, we've all tried to build what we think our best case scenario of the risks are into our estimates.
And do you see any threat of correction to the stock market or recession, possibility of recession coming from these kind of volatile things that are happening at the federal level?
I don't know that we talked much about our forecast for the stock market. I can speak to SFAs versus the RSQE forecast. And one of the outside forecasting services that all three agencies have access to. Market differences, for instance, Standard & Poor's forecasts that by the end of end of calendar year 28, that the market would be down around 6,000 relative to where it's at now. RSQA has a number closer to 8,000. That's a pretty big variation in terms of the stock market. Fortunately, there is a bit of a detachment between the stock market and what goes on in the economy. So, you know, while there is a wealth effect on consumption, that's one of the reasons why consumers have been resilient. On the other hand, as was pointed out at the November RSQE conference, you could have some meaningful correction in stock market valuations, and a lot of consumers are still going to be considerably better off than they were a number of years ago.
Thank you.
Thank you. We know how much time goes into these forecasts, and I know I speak for everyone up here. We really appreciate all you do. Thank you. All right. Now we will take a listen to the estimates of K-12 pupil membership and foundation allowance. This will be Ryan Bergen from Senate Fiscal, Noel Benson from House Fiscal, and Alex Holmden from the State Budget Office.
see this better now? Thank you for having us.
All right, thank you. So thank you for having us. We're here to present the updated pupil forecast for fiscal year 26, 27, and 28. I should note that the fiscal year 25, 26 estimates at this point are still technically a forecast, but they're mostly, the actual count has come in. You can see that the second column is the change from our May estimate. You can see that for local districts, between our May consensus estimate and the actual count that came in after the October count day, local districts were down about 4,200 pupils from that forecast, and public school academies were down about 1,800 pupils from that forecast. So there was a significant decline from the initial forecast. These numbers could still change slightly after the spring audit, but we're pretty confident at this point that this is what the FY 25-26 numbers are. So that leaves us with 1,216,600 pupils in local districts and 155,200 in public school academies, which on a year-over-year basis still shows a decrease in local districts of more than 13,000 pupils, but a small increase in public school academies of 850. At this point, the difference between our forecast and the actual count is partly up to speculation. We don't have good data on number of students that have entered homeschooling or non-public schools. And it's also a possibility, especially since we saw significant declines in kindergarten enrollment, that either students are going to non-public schools or homeschooling, or there are fewer two-year kindergarten students because of the increase in pre-K over the last couple of years. If it's an increase in pre-K, then we're still seeing the pupils essentially within the state of Michigan. They're just showing up in pre-K instead of as a second year of kindergarten. With more data, we'll know more of that. So right now, we're mostly speculating, but I would point out that even though this shows a decrease of 12,500 pupils from the previous year, that is a decrease of 0.9% as opposed to the decrease of 0.5% that we had forecast in May. Moving on to 26-27, the decrease total is 8,400 pupils. Most of that is carrying that 6,000 pupil drop from FY 25-26. And then all of our models were obviously affected by that, so our trend lines are running lower. So that brings us to 1,205,000 pupils in local districts, 156,700 in public school academies. You can see it's an increase of 1,500 for public school academies and a continuing decrease of 11,600 in local districts. I would note that this is roughly in line for the local district decreases that we've been forecasting the last few cracks. The main difference is that the growth in public school academies is tempered a bit. Let's see, and our first estimates for FY 27-28, we have 1,193,200 pupils in local districts, so a further decrease of 11,800. Public school academies go up to 158,000, so an increase of 1,300, for a total decrease of 10,500. And I'll note that the total decrease for FY 27 is 0.7%, and total decrease for FY 28 is 0.8%. The last thing on here is the non-public dual enrollment costs that are in the MyLeap budget. These are actually not forecast for the next year because in the current budget, they are shown as one-time costs. So we're just reflecting them here. It's $3,500,000. And then the last point is just a pupil membership adjustment factor. This is really just taking the current year divided by the next year pupils. So for FY 26-27, it's 1.0074. FY 27-28, it is 1.0078. And with that, we are happy to take any questions.
Move adoption of the estimates.
My second?
All in favor?
Aye.
Any opposed? Thank you so much. At this time, the panel will take a recess and discuss the numbers we've seen, the presentations we've heard, and we will come back. Thank you. We are at recess.
What is it?
All right, we will call our meeting back to order. And I'm going to turn this over to David to discuss the handout.
So I will skip the economics so that we don't have to listen to my best Ben Stein imitation, and move to revenues. So the proposal is that FY26 revenue would be 14.1 billion general fund, 19.1 billion school aid fund, for a total of 33.3. That would be roughly $780 million less than the May consensus conference. As we pointed out in the individual speeches, much of that was already on your old balance sheets. Instead, we've moved it to the consensus forecast, taking it from one spot to another. In terms of FY27 revenue, the proposal is $14.1 billion, a 0.4% decline. In general fund, $19.6 billion school aid, a 2.3% increase, for a combined total of $33.6 billion, up 1.1% from FY26, and roughly $1.1 billion below the May CREC. Again, most of that is reflected with moving stuff from the budget balance sheets to the consensus estimates. And for FY28, the proposal would be 2.9% increase to $14.5 billion in general fund, a 2% increase to just under $20 billion in school aid fund, for a total of just under $34.5 billion in combined revenue. Revenues would still be well below the revenue limit over the forecast. You can see the long-term trend growth for out years, and you've already agreed to the school aid numbers.
Any discussion?
No? Move adoption of the estimates?
Second. All in favor?
Aye.
Any opposed? The proposal is adopted as the consensus revenues. Thank you. And again, thank you to all of the presenters and staff, everyone who's worked on the forecasts, the presentations, et cetera. We really appreciate all the work that goes into this. Any other comments from anyone? All right. Thank you. With that, the meeting is adjourned.